Hanji guys, hello friends. We are live. We are live. We are live. We are live. Can you all hear me? Can you all see me? Just confirm me. Good morning, sir. Good morning. Good morning. Can you all hear me? Audio video clear now? Yes, sir. Yes, sir. Okay, let us start. Okay, Ji. So, hello everybody, and welcome to this Safe and Direct Access and International Taxation Full English Live Power Batch. A very warm good morning to all of you present here. I hope you all are doing really, really well. Please let me know in the comment section your status so that we can start off with today's session. To be very precise now, it is always difficult to wake up, motivate yourself to attend this class every day. Every day I feel like, yeah, let's cancel today's class. Let's cancel today's class. But still, coming up and taking class, it is a difficult task for me. It has never been my routine to wake up and take these classes in the morning. And similarly, so does your also. There are many people who never had a habit of waking up in morning, but still somehow you are waking up and you are doing well. So kudos to your efforts, and I hope this continues throughout the batch. And of course, a bit more stretch is required. Every day we'll feel like that we want a break. Can we skip today's class? Can we skip today's class? Right answer is you don't require break on regular basis. A weekend break is sufficient. Most probably, most probably you should continue classes on a regular basis. We should not try of we should not try to think of leaving a single day. Remember, huh? Always you will be motivated to leave that class. Always you will be motivated because sleep is something that nobody can compromise. But waking up, sitting for the class, participating in the class actually is a difficult task which requires a lot of efforts, and you should do that because time for exam is very less. Done, sir. We got your point. Let us first recall what we have studied till now. Not yesterday, but till now. What we have studied till now since inception. We started with income from capital gain, where we understood the basics portion. What was the basic portion? We understood what is charging section. Any gain arising from transfer of capital asset shall be taxable under that capital gain. We understood what is capital asset, the entire definition of asset. All the assets are capital assets. ULIP, what is ULIP, and F securities held by FIIs. Then we understood period of holding. If assets are held for more than 1 year or 2 years, they shall become long term, else they shall become short term. We understood definition of transfer, any kind of sale, exchange, relinquishment, extinguishment, compulsory acquisition, conversion, transfer of immovable property, and zero coupon bond. Whatever we had studied, we had rural agriculture land, any area which has municipality, municipal corporation, 2 kilometer, 4 kilometers, 6 kilometer area, and 8 kilometer area. We had this was all the basics portion. Then we came on to computation portion, where we understood the format of computation. In the format, we have to understand that how do we compute full value of consideration. Full value of consideration is normally the money receivable, but it is possible you are transferring immovable property, so you might have to see 50C. 50C means you have to check the SDV as well. If you are transferring unlisted shares, then you might have to check FMV. If you are transferring any other asset, then FMV is to be checked. What shall be the cost of acquisition? Ideally, cost of acquisition is the price paid to acquire the asset. It shall include any direct expenses. It shall include any expenses incurred for clear title. It shall exclude any expenses paid on STD. It shall exclude any expenses on which deduction has already been taken. But we studied special cases as well. For example, I received assets at free of cost, that is gift. I bought an intangible asset, or I have self-generated intangible asset. For example, if I have a very old asset, that means before 1st April 2001, I had acquired the asset, so I shall get FMB benefit. What about depreciable asset? We shall take cost of acquisition as WTV. Bonus shares normally nil, but we shall get the benefit of FMV. Right shares, sir, ideally price paid to the company for acquisition of rights, that is cost of acquisition. But here we get some capital gain as renouncement money. ESOP, normally the FMV on which option is exercised is the cost of acquisition for ESOPs. At last, we have demerger. Lawmaker says that in case of demerger, percentage of assets transferred to the newer entity will be the percentage of the share price of the newer entity. Then we came on to some advanced cases where we understood ULIP taxation. We understood that if ULIP is more than 10%, then it shall always be taxed under capital gain. But if it is less than 10%, it would be exempt till 1st of Feb 2021. With effect from 1st Feb 2021, 10% plus 2.5 lakh shall also be exempt. Beyond that, it shall be taxed. We studied this ULIP taxation. Are Baba, are you remembering or not? Remembering or just forgot? Remembering or just forgot, sir? We remember ULIP taxation. Then we have slump sale. We understood that when you are transferring the unit, you had two options. Either you can transfer as a unit as a whole, where you require three things: full value of consideration, one, FMV2, and cost of acquisition. FM1 was the FMV of the assets given, FMV2 was FMV of the assets received. Or cost of acquisition was nothing but assets transferred. If depreciable, then take WDV. If non-depreciable, take book value. Then we came 45.4 and 9. 45.4 and 9, we said that if partnership firm gives any asset to the partners, then you have to see whatever in capital gain would have been there if we would have sold this asset to an outsider, then such capital gain should be taxed in the hands of the partners, in the hands of the firms. Second thing, whatever overpayment of capital you are doing against his required capital, that shall be taxed under 45.4. This is what we had studied. 50AA. Three securities will always be taxed under short-term capital gain. We had market-linked debentures, where interest is dependent upon some underlying asset. We had specified mutual fund, where mutual fund was issued for on or after 1st April 2023. Up to 35% was in equity. Then we had unlisted bonds and debentures. Advance money forfeiture. If you had received some advance money and you forfeited that with effect from 1st April 2014, such advance money shall be taxed under IFOS. But if such advance money is forfeited before, then it shall be taxed. It shall be reduced from cost of acquisition. Then we had demat securities. If you had securities in demat, then FIFO method shall be used for cost of acquisition. After doing the computation, now you were there to save the taxes. First of all, saving required section 54. If you had residential house property, you sold residential house property and bought new residential house property in India, capital gain was exempt. You were required to buy within 2 years. Within 3 years, you were required to buy the house. Second thing was 54B. If you had urban agriculture land, you sold urban agriculture land and bought the rural agriculture land or urban agriculture land within 2 years, then any short-term, long-term capital gain was exempt. Third point was 54D. If you had land or building for industrial undertaking and such land or building was compulsory acquired, then lawmaker says that this capital gain shall be absolutely exempted provided you buy new land or building for industrial undertaking. Then fourth was 54EC. If you transfer any land or building which was long-term capital asset, lawmaker says we would exempt that provided you buy new bonds of NHAI, RECL, PFCL, IFCL, HUDCO, IREDA. You might buy these 6 bonds. Then at last we had 54F, where individual HUF transfers any asset except residential house property on such property. 54F would be allowed to use exemption. Amount of exemption was capital gain into cost of new asset divided by net consideration. This is what we had studied in exemptions. Then we came on to tax rates, where we understood that if assets fall under 112A, in that case 12.5% would be taxed over 1.25 lakh. We understood that there were 3 instances of STT, instances where STT is not even required to be paid, and instances where even after paying STT, you will not get any benefit. Then we also understood how do we calculate the cost of acquisition for such shares. See, FMV benefit we get on 31st Jan. Then we came on to 111A, where we studied 20% tax rate is applicable for short-term capital gain on such listed securities. Then we had 112, any long-term capital gain which is other than 112A, then it was taxed at 12.5%. There we had an exception. What was the exception? Lawmaker said that if there was an individual HUF who acquired MOL property before 23rd July 2024 and transferred it thereafter, then tax calculation shall be done as 12.5% without indexation or 20% of capital gain recomputed with indexation. This is how much your capital gain would arise, and this is how much your tax would be applicable. Does that mean we really have indexation left with us? Honestly speaking, for computation purposes, the indexation is not there as of now. But for tax calculation purposes, you might do indexation. Sir, but yesterday you started up a topic. It is possible that transfer took place before 23rd July. It is possible that transfer took place before 23rd July 2024. Then in that case, you might have to index. And those were the four cases. Let us discuss it today. Is it clear? I mean, whatever we have studied, were you able to recall? Whatever we have studied, were you able to recall? Vipul, hi sir, doubt. Yes, you can ask doubt anytime. You can ask. What's the doubt? Were you able to recall things on a broader view? See, was my intention to remind whatever thing I have studied, whatever I have taught? Right answer is no, that wasn't the intention. With this revision, I always want to brain map what we have studied. The chapter bigger like capital gain, you should always focus what we have already studied. Minute points is left up to you. You have to read it, you will be able to recall. But broader picture I put so that you are able to understand what we have studied and what we are left with. Got it? So that broader picture is always clear in your brain. Moving further. Done, sir. Section 45.1. What this section says, try understanding. Very simple section it is. For example, this is me, Rahul. I had a house acquired for 20 lakh rupees in previous year 1 2. I was staying very happily with my wife. We had the best life we ever had imagined, the dream life. And you know what? One day we decided to go to Switzerland. Wow. We decided to go to Switzerland. It was 1st April 2022 that we went to Switzerland. We were looking out the hills in Geneva. We planned to visit Zurich. There were multiple places where multiple movies, Indian movies were shot. We planned to visit Switzerland. I mean, such a beautiful country, such a beautiful country. Me and my wife went to visit Switzerland. You'll not believe. We were just looking at the hill stations. I mean, it was such a beautiful view, and all of a sudden there was a call. All of a sudden there was a call from India. I picked up the call, and the person said, Rahul sir, what are you doing? What are you doing? What are you doing? What are you doing? I said, I am enjoying in Switzerland. That person said, Rahul sir, your house has caught fire. Your house has caught fire. My happiness all of a sudden vanished. My happiness all of a sudden vanished. My entire happiness was lost. That my house, which I had cherished since my childhood, which I had decorated with my wife, is now lost in fire. I was saddened. I was deeply saddened by the thought that entire house is gone. Oh dear God. Oh dear God. But my wife, on the other hand, was laughing. She was laughing. There was no bound to her laughs. She was continuously laughing. She did not stop laughing. I said, what happened? Our entire house is lost. Our entire house is lost. He says, dear, you can be careless, but I am not. You can be careless, but I am not. I had already taken a fire insurance against our house. Insurance company will pay us 1 crore rupees in future. Yay! Even our house was already old. We already have a required to get that reconstructed. So instead of that, we'll get money from insurance. Such a beautiful thing. Such a beautiful thing. We already were required to vacate the house. We vacated the house during Switzerland. And meanwhile, only fire caught. So we'll get money from insurance and we'll buy we'll reconstruct our new house, a dream house. We were very happy. Now provision arises here is provision involved is, sir, destruction took place on 1st April 2022. Can I say destruction amounts to transfer? Can I say destruction amounts to transfer? Can I say destruction amounts to transfer? Yes, sir. Of course, you can say destruction of a capital asset is nothing but extinguishment of rights in an asset, or you can say that relinquishment of an asset. Destruction shall amount to transfer. That means tax should be charged in previous year 22-23. Yes, but issue involved is now government cannot logically charge taxes in that year. Government cannot tax in that year. In this case, sir, tax is being charged in the year in which insurance received is there. Insurance receipt. Insurance receipt. Tax will be charged in the year in which insurance money has been received. Fine, sir, fine. So how capital gain will be taxed? Capital gain will be computed in year of insurance receipt, but transfer took place in year of destruction. This is the essence. Transfer might have took place in some other year, whereas tax would be applicable in some other year. How capital gain would be computed, sir? Full value of consideration will be amount of insurance receipt minus transfer expenses. This will give us net consideration minus cost of acquisition. Now here comes an important portion. Here comes a very important portion. Sir, what will be your cost of acquisition? Of course, this 20 lakh will be cost of acquisition. Am I going to index that cost of acquisition? Point here is, am I going to index that cost of acquisition? Sir, I have told you if transfer take place after 23rd July 2024, no indexation whatsoever. For computational purposes, no indexation whatsoever. But now you tell me, when did transfer took place and should I be indexing or not? You have to tell me that when did transfer took place and should I be indexing or not? Should I be indexing or not? Just you tell me. You tell me. Yes, sir. No, sir. Now listen. Again, stick to the basics. When did transfer took place? Sir, transfer took place on 1st April 2022. Transfer took place on 1st April 2022. If transfer has taken place before 23rd July 2024, then instead of cost of acquisition, we shall take index cost of acquisition. We shall do index cost of acquisition 20 lakh. Divide by CII of year of acquisition, multiplied by CII of year of transfer, and this will give us the index cost of acquisition. And we shall reduce it, and then we shall arrive at capital gain. Indexation has to be done. Very carefully, I am again referring to this chart. See, if somebody is having doubt now, come on to this chart and you will understand. Sir, when did asset transfer took place? Just look at this. If asset was destroyed in 2022, then transfer took place in 2022 only. Even though we are charging tax today, but transfer took place in 2022 only. Transfer did not take place today. Transfer took place in 2023 only. So if transfer took place in 2023 or 2022, in that case, indexation should have been done till there. Are you getting this point? But if transfer would have taken place in this year, for example, 25-26, then indexation was not required for computation purpose, but we might have done indexation for tax calculation purpose. Are you getting this point? The basics have to be cleared. I am repeating this multiple number of times. There are two steps to a capital gain computation. First of all is computation of capital gain and computation of taxes. While computing capital gain, indexation is not to be done if transfer has taken place after 23rd July 2024. If done before 23rd July, then indexation is to be done for computation as well. But for tax calculation, so tax calculation only after 23rd July 2024, only on immovable property transferred by individual HF, then tax calculation will be done with indexation. That is what the essence of the topic is. Did we understand this is a special case? Did we understand? I don't know why, but I personally think that these topics are important from examination point of view, because in these topics now you might have to index. You might have to index. That is why these topics I personally think are really important. Now we have second person. Kavya. See, whatever examples I take now are just examples in nature. Please do not personally mind it. I might take anybody's name, but I do not want to demean anybody. It's just an example to illustrate you things. Do not take it otherwise. We have Kavya with us. You know what? Kavya was born on 1st April 2021. Oh, 2001. She was born on 1st April 2001. And as soon as she was born, her mother was very happy. Very, very, very happy. And as soon as she was born, her mother bought a piece of gold. A piece of gold. How much? 2 kg gold. As soon as she was born, 2 kg gold was bought by her mother. Wow, sir. Wow. 2 kg is gold. Wow. She grew up. She grew up. मजा आ गया. Oh, oh, oh. You understand Hindi, Deepak? I don't know. On 1st April 2021, Kavya says, "Mummy," I mean, she was not. She was like, she wasn't. She was very filled with more gratitude. "Mummy, I cannot study more. I cannot study more. I just don't want to study this other subjects. DT is beautiful. We are able to understand DT beautifully because of Rahul sir. But other subjects of CA final, I don't want to study. No, no, mummy, I don't want to study." She denied the CA course. She denied CA course. She said, "No, no, I don't want to study any other subject. DT is the best thing. If I want to study that only. Otherwise, I don't want to study." And DT only because of Rahul sir. That day she left it. She left studying for CA final, and now she wanted to start a newer thing. She wanted to start a newer venture. So she just looked at the locker and she saw 2 kgs of gold. Now what she did? She thought that instead of keeping that gold in Almira, why shouldn't we get jewelry constructed? Beautiful, beautiful design. Kavya is very creative. Very, very creative. I personally know her. Very, very creative. Beautiful jewelry. Like crazy beautiful jewelry she creates. So she created a jewelry store. She started a jewelry store out of 2 kg jewelry. On that day, the market value of that gold was nearly 1.2 crore. At that time, her mother had acquired for just 15 lakh rupees, but as of now, it is 1.2 crore when she was converting it. You will not believe this, but she created the jewelry. She created different designs of jewelry, very different, very unique, very antique designs of jewelry, and people really loved. And in on 1st April 2025, 50% of entire jewelry was sold. Oh my god, oh my god, at rupees 2.5 crore. Wow, sir, wow. She had a gold brick. She has been using this gold brick as investment. But one day she realizes that this is not my investments. I want to convert it into stock in trade, or for my business asset. I want to convert it into stock in trade. I want to start business with business of these properties. In this case, what happens, sir? As soon as you convert any capital asset into stock in trade, as soon as you convert any capital asset in stock in trade, in this case, this conversion amounts to transfer. conversion amounts to transfer. That means transfer of this gold took place in 2021 only. That means capital gain will be applicable in 2021 only. But is she required to pay tax? Logically, just to think now, she has just converted that. She has converted the nature of gold from capital asset to stock in trade. But is she has she got any money? So she has not got any money. No money has been received. If she would have got some money, then it was fine. But she has not received any money. No money has been received. Therefore, it's not wise enough to take money from her. It's not wise enough to take money from her. That is why now lawmaker says that capital gain will be calculated in year of transfer, but tax will be charged in year of sale of stock in trade. Percentage sold, percentage charged. What does that mean? I'll tell you. Okay. Now, what does this simply imply? Once you convert the capital asset into stock and trade, now you have to compute the capital gain. You have to compute the capital gain. But issue involved is capital gain will not be taxed in your hands immediately. It will be taxed when your stock and trade is sold. Conversion, whenever will take place, now you will be charged the capital gain here only, but you will not be taxed. I mean, capital gain will be computed in your hands. Capital gain will be computed here, but the government will not take any money from you. As soon as you start selling this stock in trade now, government will start taking tax from you. And the percentage of stock you are selling, the same percentage will be charged to you. The same percentage of capital gain will be charged to you in your hands. Now, how capital gain would be computed? Sir, capital gain will be computed in financial year 21-22. Full value of consideration. How full value of consideration is computed? Listen very carefully. See, whenever conversion takes place, 15 lakh worth of gold was converted, and on that day, FMV was 1.2 crore. So, full value of consideration shall be FMV on date of conversion 1.2 crore minus cost of acquisition. We shall do transfer expenses as well, but there are no transfer expenses, so I'm directly doing cost of acquisition. Now, remember, what will be the cost of acquisition? Sir, cost of acquisition will be 15 lakh. But don't you think that there is a provision that is going to be applicable? We ended with that provision. We started with that provision, sir. Don't you think that transfer took place before 23rd July 2024? Don't you think that transfer took place before 23rd July 2024? So there will be a special provisions. There will be special provision applicable. Don't you think, sir? Again, cost of acquisition will be indexed because transfer has taken place before 23rd July. And how indexation will take place? Divided by the ECIA of year of acquisition multiplied by CIA of the year of transfer. What is the CIA of year of transfer? 301. Divide by 100 into 301. 45.15, and our capital gain will be 74.85. 74.85 will be capital gain. Now, will this be charged to taxes today? Absolutely no. Absolutely no. When this will be charged to taxes, lawmakers say that this will be charged to taxes in the year in which stock in trade is sold. So if stock in trade is sold in previous year 25-26, 50% of stock was sold. So out of this capital gain, 50% would be charged to tax in previous year 25-26. So into 50%, 34.425. 34.425 will be charged to tax in previous year 25-26. Remaining stock whenever will be sold, at that time remaining capital gain would be charged. As soon as your remaining stock will sell, remaining capital gain will be charged. Basic provision, basic fundamentals that you have studied and shall continue here as well. How PGBP is going to take place? See, PGBP will be money received is 2.5 lakh, 2.5 crore. To construct the jewelry, I mean, money has not been given. For example, making charges for jewelry is making charges are 40 lakh. Okay, so to create this jewelry, where 2.5 crore has been received. Making charges are nothing but 40 lakh. And cost of jewelry shall also be taken. How cost will be taken? See, cost will be the FMV. Wait a second, wait a second, wait a second. I have to cover that thing. Krish, I have to cover that thing. Don't worry. Whatever you think beyond that, I'll cover. Don't worry. Now, cost will be 1.2 crore. The FMV that was there, now such FMV shall work as cost of acquisition, and FMV, because half of the asset is sold, so 60 lakh will be cost. And all in all, 1.5 crore would be taxed in your hands under PGBP head. Did you understand the computation portion? Did you understand the computation portion? Just tell me, just confirm me. Did you understand the computation portion, sir? We understood. Simple provision. There is nothing special in this. We just have to see the FMV on the date of conversion. The FMV has to be full value of consideration. We will compute capital gain in the year of transfer only, but we will pay taxes only when stock in trade is sold. Perfect, sir. Perfect. Now, issue involved is, sir, there are two personal issues. Personal issues. Somebody who some issues which people do not talk about. Yesterday only we studied an exemption called 54 EC. Yesterday we studied an exemption called 54 EC, sometimes 54 F as well. For example, if this would have been the property, if this would have been immovable property, if this would have been immovable property, just think for a second. And we might have converted them on 1st April 2021. If we wanted to claim exemption under 54 EC, we were required to buy asset, we were required the bonds of NHAI, RECL, PFCL, IRFCL within 6 months from date of transfer. But here, after transfer, we have not even received money. So how can we buy these bonds after date of transfer? Practically, this is an issue now. If I want to claim exemption on the capital gain, I have to buy bonds of NHAI within 6 months from the date of transfer. But transfer took place in 2021, where no money was received. How come we can ascertain the value of the asset? How come we can buy even capital assets or bonds? Not even possible, no? Or not even possible. So lawmakers or CBDT specifically gave a clarification in this regard that in case of conversion of capital asset into stock in trade, in this case now, 6 months shall not be taken from date of transfer, rather 6 months shall be taken from date of sale of stock in trade. Here 6 months shall not be taken from the date of transfer. To buy bonds now, from 2021 you shall not buy. You shall buy bonds when you sell the stock in trade. Sir, for example, half of the stock is trade is sold in 2025-26. So we might buy 34 lakh of bonds. Next year, we might buy in remaining of the 50 lakh. Next year, we might buy, whenever you will be selling the remaining amount of stock, now at that point of time, remaining bonds you can buy. Simple provision. So what the basic is? 6 months from the date of transfer is not to be checked. Rather, 6 months from the date of actual realization of stock in trade is to be checked. That is the basic fundamental. Done. This is the first personal issue that people normally forget. This has been answered by CBDT only. Now the biggest question of all arises, sir. This capital gain, or of course last question is also capital gain. What will be the tax rate on this capital gain? What will be the tax rate applicable? See, I am telling you a provision, clear-cut provision. What the provision was? Section 112 clearly stated, okay? Section 112 clearly states that if transfer took place before 23rd July 2024, then tax applicable to the assets was 20%. And later on, when transfer took place after 23rd July, tax rate applicable is 12.5%. This is the history of entire 112, section 112. In this case, personally speaking, on this 34 lakh, what should be the tax rate applicable? What should be tax rate applicable? Sir, we have two options. Since capital gain has been computed, listen very carefully. Since capital gain has been computed with indexation, and section also says that we should tax it at the rate of 20%. Why? Because transfer took place before 23rd July. This is the specific thing mentioned. But practically speaking, if you feed these data into income tax portal charges taxes at the rate of 12.5%. This is as per income tax portal. Income tax portal doesn't charges at 12-20%, it charges at 12.5%. If transfer took place before 23rd July, you got the benefit of indexation now. You already got the benefit of indexation, so tax rate should be higher for you. Ideally, you should pay 20% taxes only. But ITR portal charges just 12.5%. Now, in that regard, which tax rate we are going to follow? Personally speaking, ICI corrects both of them. You might charge logically 20%, which is correct. You might charge 12.5% by mistake, that is also correct. Both the tax rates are correct in this regard. ICI corrects both of them. If transfer took place before 23rd July, then tax rate might be 12.5%, might be 20%, depending upon your wish. ICI, if charges 20%, give alternate answer with 12.5% as well. If it charges 12.5%, then it gives suggested answer with an additional remark that 20% could have been charged. So both the rates are corrected by ICI if transfer took place before 23rd July 2024. But if transfer took place after, then flat 12.5% will be charged, except for individual HUF. That you understood. Okay? This is the entire section. This is entire conversion of capital asset to stock in trade. I hope you are able to understand this. Okay? Just give me a second. Just give me a second. I'll be back in a. I'll be back. Okay. Did you understand the tax rates? How tax would be applicable on this provision? Dear beloved, did you understand this provision? Sir, we got your provision. Now coming on to third special case, that is compulsory acquisition. Yes, sir. If you have doubt now, you can ask me. Okay, this is the topic. If somebody has any doubt, they can ask anytime. Now, we at FAST have a very special faculty for AFM. If you are struggling with AFM, you can anytime ask. You can ask, you can go for his lectures. He's absolutely fantastic for AFM, but that is not about him. Today, I want to reveal his real face. You know Adish sir? Have you ever seen Adish sir? Adish Jain sir? He teaches AFM. He also teaches in English as well. But today, I want to unmask him. The real face of Adish sir I'll be showing today. How he actually is. You know what? It was just back in 1990s, where he had acquired a farmhouse in Kolkata. He acquired a farmhouse for 50 lakh rupees, or not 50 lakh, just 20 lakh rupees. 1 acre, yeah, 4 acre in Kolkata. He had acquired a farmhouse, 4 acre farm worth rupees 20 lakh he had acquired. And every year, I please don't talk to him. Please don't say this to him. But he has been growing opium there. He has been growing opium there. So, but he teaches very nicely. Arey, that is a second phase. You don't know. He actually grows opium in Kolkata. You don't know. On 1st April 2001, this farmhouse was valued 50 lakh rupees. And SDV was 45 lakh rupees. Oh my God. Oh my God. Sir, we know his real face. Teaching aside is his knowledge. See, please do not say this to him. Otherwise, he'll get angry that I revealed his real face. Please do not say this. Okay. He has been teaching very well. Side by side, every year he was selling opium and he used to earn 4 to 5 crore rupees just by selling opium. Teaching is his side business only, but he was able to sell opium for 4 to 5 crore rupees per annum. Per annum. He had a very successful venture, and it was back in 2021. It was 1st April 2021, where newly elected TMC government came to Bengal. And Didi said, we will make a Durga temple. We will make a Durga temple. We will not let the youth waste their time. We will not let our youth waste our lives in this opium. No, 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 no. We will take away your land. We will take away your land. In that year, Didi compulsorily acquired this piece of land. Compulsorily acquired this land. Oh my God. And you know what? How much compensation she announced? You know what? How much compensation she announced? She said only 2 crore rupees I'll pay. Hey? 2 crore of compensation announced. Are more than that he earns a year? 2 crore compensation of a land. 2 crore compensation for a land. Chhi. Chhi. Didi said, I can only pay 2 crore for 4 acre of land, yielding 4 to 5 crores a year. She announced a compensation of 4 crore only, 2 crore only. Adish sir became very angry and he went to court. He said, Judge Saab, I want more, I want more, I want more compensation. Judge Saab said. He said to Judge Saab, that Judge Saab, I want more compensation. What is this? See, what is this? What is this happening? Court went on, Tariq pe Tariq, Tariq pe Tariq, date on date, date on date, date on date. It was 1st April 2025 that out of this 2 crore, 1 crore was received as first installment of initial compensation. And on 1st April 2026, another 1 crore was received for second installment. Time passed, and it was back in year 1st April 2031 that court ordered government to pay 10 crore rupees as additional compensation. This compensation also government did not pay. It was back in 2033 that government paid this 10 crore. And government had to pay interest on that on 1st April 2034. Government had to pay interest as well. How much interest? So 3 crore rupees of interest government paid on this late compensation. This is his real face. I mean, this real face has nothing to do with the way of teaching he does. He teaches very beautifully. You can always go for his classes. But yes, this is the real face. This is the real face. Nobody will tell you in the market that how struggle he has done in his life. He used to personally go to farms and yield the opium. He used to pack in small packets and sell it to market. Nobody knows his real face. Now, how this transaction would take place? First of all, this is the classic example of compulsory acquisition of capital asset. Compulsory acquisition of capital. It's a classic example. Every point has been covered in this question. Listen very carefully. 1st April 2021 is the compulsory acquisition date. This is the date on which asset has been compulsorily acquired. But do you think that tax should be charged in that year? Do you think that taxes should be charged in that year? So tax cannot be charged in that year. Honestly speaking, tax cannot be charged in that year because money has not been received now. So tax normally is being charged in the year in which money is received. Now here we have two kinds of money received. First of all is initial compensation. Now, what is initial compensation? We already understood that announced by the government, as announced by the government. Whatever government announces now, that is initial compensation. In our case, initial compensation is 2 crore rupees. Sir, when this is being taxed? Sir, this is being taxed in the year in which first installment is received. taxed in year of first installment, the year in which first installment is received. How much it shall be taxed? Full value of consideration. Sir, first installment is received in previous year 25-26. First installment is received on 1st April 2025-26. That means previous year 25-26 is the year in which tax would be charged. Very important point here. Sir, full value of consideration shall not be 1 crore, but entire initial compensation. Even though you received a part of the installment, or even if you received any one installment out of the entire initial compensation, tax would be charged on the entire initial compensation. Even if you receive part of it now, entire initial compensation will be taxed in case of first installment only. Why? Because government doesn't want to delay their taxes. As soon as you receive the money, you are eligible to pay taxes. Just to pay taxes right now, whatever the later installments you will get will be exempted. Listen very carefully. You received only a part of installment, but entire initial compensation will be taxed in case of first installment only. Minus cost of acquisition. Sir, what will be cost of acquisition for Mr. Adish? Adish, sir, 20 lakh was actual cost, but we never take that. We have FMV available. FMV is 50 lakh rupees. But sir, FMV was FMV was 50 lakh, but stamp duty value was 40 lakhs, 45 lakhs. So maximum 45 lakh we shall take. 45 lakh would be the cost of acquisition. Now, since 2001, it is FMV, so we shall also do indexation as well, now, because transfer took place before 23rd July. Transfer took place before 23rd July. And we shall do indexation into 301 CIA of the year of transfer. 135.45. So 64.55, this is the long-term capital gain on this initial compensation. Sir, what about this second installment received? Second installment in previous year 26-27, no treatment. Because entire initial compensation was taxed in first year only now. So no treatment of the enhanced no treatment of second multiple installments of the initial compensation. No treatment. Then we have enhanced compensation. What is enhanced compensation, sir? Compensation that is awarded by court. Enhanced compensation that is awarded by the court. Now, enhanced compensation is taxed as and when received. As and when received. Whenever you receive enhanced compensation, in that year it will be finally taxed. Whenever you receive it. So when did you actually receive? Sir, court order came on 1st April 2031. But you did not receive that enhanced compensation. You received it on 1st April 2033. So it will be taxed in previous year 33-34. Full value of consideration is the entire enhanced compensation minus cost of acquisition. Sir, here we shall not take cost of acquisition. Why we will not take cost of acquisition? Because entire cost of acquisition has already been claimed here now. Entire cost of acquisition has already been claimed. So we will not take any cost of acquisition here. This will give us the capital gain 10 crore rupees. Sir, will this be long term or short term? Sir, it will be absolutely dependent upon this original capital gain. If this capital gain in case of initial compensation was long term, then capital gain for enhanced compensation will also be long term. If capital gain for initial compensation was short term, then capital gain on enhanced compensation shall also be short term. Nature of enhanced compensation will always be dependent upon the nature of initial compensation. In this process, if he has paid any litigation charges now, litigation charges would be allowed to him because he went to court on regular basis. So he had to incur some court fees, lawyer fees, multiple fees he had to incur. That can be reduced here. Fine, sir. Absolutely fine. Sir, what about this interest component? So interest is taxable. Interest on late compensation is taxable under IFOS. Under IFOS, always understand whenever you receive any interest on late compensation, it is taxable under IFOS in the year of receipt. The year in which you receive that now, it is taxable. For example, now interest has been received in 34, so it will be previous year 34, 35. Whatever interest you receive, for example, you receive interest of 3 crore, less you shall do 50% of standard deduction. You get a standard deduction 1.5 crore. So only 1.5 crore is taxable. This is the taxable amount. This is the taxable amount. Did you understand this point or not? This is the entire concept of initial compensation, enhanced compensation, or all in all, the compulsory acquisition. Now, there are certain pointers that are worth understanding. Come on to book. We have certain pointers which are worth understanding. Okay? First of all, any interest on late compensation shall be taxable under IFOS, and you get a standard deduction. Yes, sir, we got that. Sir, for example, listen. If you receive any compensation now under Section 96 of Right to Fair Compensation, Transparency, Land Acquisition, Rehabilitation, Resettlement Act 2013, then it is absolutely exempt. Sir, do we need to learn this act? No. You just need to learn that there is a very big act called Right to. We have a very big act. Right to Fair we have an act. That act, whenever you receive any compensation under Section 96, that is absolutely exempt. You have to remember that thing. Okay. In addition to that, there are 2 pointers to worth understanding. Listen up. For example, in 2021, Adish sir went to court, and later on court gave a judgment that Chi Adish sir, Chi, very bad, very bad. This 2 crore has been also given extra. You should have been given only 1 crore as compensation. Sir, can court even decrease the compensation? Sir, court can even decrease the compensation. Court might even decrease the compensation. In that case, what will happen? Adish sir had already paid taxes now. In that case, what would happen? Sir, in that case, a rectification order shall be passed by the assessing officer adjusting the already paid taxes. Okay. So it is possible that court might reduce the compensation, then AO will pass a rectification order. Sometimes, this is a very logical thinking. Do not get confused, but sometimes what happens is, just think of it practically. On 1st April 2021, property was acquired by government. Adish sir went to court. Now, don't you think that courts are not blind? Court understand the situations. Court already knew that Adish sir is earning 4 to 5 crore on regular basis. 4 to 5 crore on regular basis he is earning. So 2 crore is not justified now. 2 crore is not justified. Just looking at the case, the court already understood that 2 crores are not justified here. At least 5 crore should have been paid. 5 crore should have been paid. Just by hearing, order is not passed yet. But by hearing at the case, only the court understands that minimum of 5 crore should have been paid. Minimum 5 crore should have been paid. Okay, court understands this basic pulse that even before passing the order, the court understand that there is something extra to be paid. How much extra, that will be finalized after final order. But there is something extra now. So court just passes an interim order to government that pay him at least 3 more crore. So he should at least get 5 crore. Sometimes court rewards enhanced compensation on account of interim order. Order is not finalized yet, but court already knew that some extra should have been given, so court gave enhanced compensation on interim order. Final order is not passed. Yes, lawmaker says that any enhanced compensation received on account of interim order of the court shall not be taxed. It will be only taxed when final order has been passed. Okay? The same has been written here beautifully. If enhanced compensation is received due to interim order of the court, then it is taxable in the year of final order. It is not taxable right now, but it is taxable in the final year. If compensation has been reduced, then rectification shall be given. Now, if you have any urban agriculture land, we had already discussed that if individual HUF has urban agriculture land and it was compulsorily acquired, if this land was used for at least 2 years, this was exempt. We already had discussed this thing. Okay? Listen now carefully. Now carefully. This was a poor example of case. Listen, a poor example. What happened was, if I was an individual and I had urban agriculture land, my urban agriculture land was compulsorily acquired by the government. I had 2 options to get more compensation. I could have simply went to court, but I did not go to court. I am a very silent person, so I went to district magistrate. And requested magistrate, sir, please increase the compensation. I did not went to court. That's my genuineness, that I did not went to court. I went to district magistrate to get compensation enhanced. Now what assessing officer says, you are satisfied with the transfer. You are not arguing about the transfer, so it shall be considered as voluntary sale. I mean, this is the poorest of the ever example that somebody can say. Just because I did not go to court, just because I did not argue to government about the compensation, I went to district magistrate just to get the higher compensation. Assessing officer said that you are voluntarily transferring. It is not compulsory acquisition. It is voluntary transfer of the asset. In that case, it should not be exempt in your hands. I mean, I feel petty about just telling this example, that just because I'm not arguing to the government about compensation, I did not go to court, doesn't mean it is not a compulsory acquisition. It is a compulsory acquisition. I am never voluntarily selling it. I am not voluntarily transferring it. Listen, what this says. In case of compulsory acquisition, assessee moved to collector for further negotiations instead of court to enhance compensation. I did not go to court. I went to collector so that my compensation can be increased. It will not change the character of the acquisition from compulsory acquisition to voluntary sale. This does not mean that I am voluntarily selling. It is compulsory acquisition only. It does not mean that I am voluntarily selling up. And exemption shall be allowed. Last point. In case of death of the transfer, enhanced compensation shall be taxable in the hands of the person who receives it. For example, assessee's properties was compulsorily acquired. Enhanced compensation is received after 20 years. For example, enhanced compensation is received by their legal hire. So it will be taxed in the hands of legal hire only. This is entire compensation, compulsory acquisition on under any law. Understood this point? Understood this point? See, there are very minute details in these topics, very minute details, but there is a limit to which we can go. I try to touch every detail. I try to touch it. It might make this topic a bit heavier, but the way I try now, I personally think that example should stick to your brain and you should be able to recollect it when you study home. Okay. Yesterday I received one message. Just I am taking a minute. Just I am sparing a minute to tell you. Yesterday I received a message. Sir, we are understanding everything in batch. Whatever you are teaching now, we are understanding. But how do we proceed? What should be our intent along with the batch? How should we do? What should we do at the home? I am telling you, simply follow what I am saying, what I am about to say. Whatever I teach you on regular basis, just read that once. Give half an hour to just turn around the pages and read whatever I have taught. The more time you will spend on reading the topic, the better concepts will be stuck to your brain. Just think that are you able to recall the examples that I have taken? Examples are the king in capital gain. Examples and format. The more examples you are able to retain, the better the concepts will retain your brain. So your ideal thing should be, whenever I teach you anything, if chapter is not over, just read the concepts on day-to-day basis. If I have given a DPQ, just to solve that DPQ. For example, mostly today our capital gain will be over. So your target will be to read the entire chapter today in a very fast track format. If you are able to recall, then just swipe the pages as soon as possible. But if today capital gain is over, now your target should be to read that entire chapter. Your target should be that. Getting it? And along with that super 150 PDF that I have shared now, you should be able to solve that super 150 PDF. I mean, those questions that are there in capital gain, now you should be able to solve that. If you are able to do that, that's enough. What intention of this batch is, everybody who listens to me should be able to read the pages of your own, should be able to recollect the examples, and the reading time that is taken by the book now, that is the self-reading time that is taken by the book, should be very low. That means when you will be revising it of your own next time after this batch, when you will be revising now, example should click to your brain. The time that you used to take earlier, that time should reduce in future. So basic intention is that only. You are able to understand every word that is written in the book. You are able to recollect those examples, and next time when you will read, you should give lesser time to reading. You should not watch any video after classes. Just read the book and you will be able to understand every provision. That is what the intention of the batch is. This is what you should be doing. Read regularly whatever we have been discussing and solve questions once we are done with the chapter. I hope that clears. Got it, sir. Third special case 45(5)(a). What it says? Joint development agreement. What does the joint development agreement imply? Try understanding. See, if I have a property, I have a 5-acre property, 1-acre property, kept idle. I have a land. I don't have money to get the house constructed, get the building constructed. I don't have the money. The fees that I receive from you will never make me able to buy to construct the property. Unless you ask more students to come to the batch, I will never be able to do the construction work. What the provision says, if I have a piece of land now, I might never be able to construct that. Okay? In that case, now I might give this property to a real estate developer like Lodha developer. I might give this property to a real estate developer. He shall construct the houses and he shall give the property in return. For example, he might give some cash to me, some money to me, plus some of the flats that will be in the upcoming in the constructed property. He might be giving something in return to me. Now, in this concept is called joint development agreement. Now, understand. If I have a piece of land and I give this to a real estate developer, can I say that my immovable property is transferred in part performance of a contract? Can I say that my immovable property has been transferred in part performance of the contract? So transfer took place as soon as I gave this property to this Lodha developer. Transfer took place as soon as I gave this property. But tax cannot be charged because I have not even received any money. So lawmakers here say that transfer will be in the year in which you handed over this property to Lodha developers, but tax will be charged in the year in which completion certificate is received by this Lodha developers. Tax will be charged in the year of completion certificate. Got it? In the year in which completion certificate is issued, tax will be charged in that year. I hope you got it. Sir, how tax will be charged? Listen. Full value of consideration shall be the assets that we'll be receiving. For example, we received 10 flats of 550 lakh each. So we got 5 crore of property. Plus whatever the money we received 1 crore of cash. That means 6 crore will be full value of concession. So whatever assets we receive, fair market value of those or stamp duty value of those, plus the money that we will be receiving. Minus cost of acquisition, index cost of acquisition. It is possible that we might index here as well. Whatever our cost was, we might have to index that as well. Okay. Minus improvement, and this will give us long-term capital gain, short-term capital gain in our hands. Very basic provision. Again, the same case, transfer might have took place before 23rd July 2024, so we might have to index the cost of acquisition as well. Then, sir, very simple case, it is joint development agreement. Three important pointers to be understood here. Three important provisions. First of all, this benefit of joint development agreement now. This benefit of joint development agreement is only given to individual and HUF. That means if an individual HUF transfers their property to developers, tax is deferred to the year of completion certificate. Tax is deferred. Tax is deferred to the year of completion certificate only in case of individual HUF. If company transfers any asset to JDA, then tax is not deferred. Company will be charged taxes today only. Taxes are not deferred. Listen, for company, for AOP, for a LLP, taxes are not deferred. They do not get this benefit. If they transfer their property to joint to developer today, they will be charged taxes today only, even if completion certificate is later, any year later. If completion certificate is issued any year later, they will be charged taxes today only. This benefit is for individual HUF. In addition to that, sir, for example, listen. Why this benefit has been given to Rahul? Listen now. For example, in 2022, I had transferred my property to Lodha developers, and in 2026, Lodha developer would be giving me 10 flats plus 1 crore cash, 10 flats of 50 lakh each plus 1 crore. My tax has been deferred to the year of completion certificate. Why it has been deferred? Because I don't have money right now. How can I pay taxes right now? How can I pay taxes if I don't even have money? So it has been deferred. What if I am looking for the buyers? As soon as I have been announced that I will get 10 flats, I am searching for the sellers. I am searching for the buyers. I found a Kavi wants to buy the house. I pitched to Kavi. Kavi, listen. Do you want to buy this flat? Kavi says, yes, sir, you are selling flat. I'll of course buy. In 2023, I sold one flat to Kavi. I have not even received a flat. I have not even received the completion certificate. Developer has not even received the completion certificate. But I have already sold the flat that I'm about to receive. I have already sold the flat which I'm about to receive. Lawmakers say that in this case, what will happen? Sir, your tax will be charged in 2023 only. If you are about to receive certain assets and you sold those assets before even receiving the assets that you are about to receive now, you sold them before completion certificate, then government will not wait for completion certificate. Government will charge taxes in the year in which you sold these assets, because benefit, overall benefit was there just to defer the taxes, because you didn't have sufficient money. You didn't have money, that is why government deferred the taxes. Now in that case, if you have already sold the assets in 2023, government will charge taxes in next year only. What the provision says, if property is transferred by Rahul before completion certificate, then this provision is not applicable. That means this benefit of deferred tax, the tax deferred to completion certificate, is not applicable. Here tax might be charged in the year in which you are actually transferring the flat. Last thing, ठीक है, last thing. For example, I gave my property to Lodha developers in 2022, and in 2026, Lodha developers gave a completion certificate. You have to answer. You have to answer in this question. 2026, they got completion certificate. I received 10 flats of 50 lakh SDV and 1 crore cash. Overall, I received 6 crore worth of assets. Out of this 10 flats, I sold one flat for 80 lakh rupees. Now, what will be my cost of acquisition? Will it be SDV of 50 lakh? Will it be SDV? Or will it be total consideration 6 crore divided by 10? That means 60 lakh. 6 crore I had received in total now. 6 crore I had received in total now. So will it be 50 lakh or 60 lakh? What will be the cost of acquisition in this case? If I transfer the assets received under joint development agreement, what will be my cost of acquisition for such assets? What will be my cost of acquisition for such assets? Hmm. Gokul says 60 lakh. Deepak, on the other hand, says 50 lakh. Oh, we have started to divide. Krishna says 60 lakh. Lokesh says 60 lakh. What other people say? What other people say? Bhuvana says 60 lakh. Oh, ho, ho. Krish says 60 lakh. Right answer is it will be 50 lakh. Kavya says 60 lakh. Oh, again another wrong. It will be 50 lakh. How? Sir, why? Why? We did not understand why. Tell us why. Wait a second. I'll tell you. I'll tell you. I'll tell you. What I got. What I got. 10 flats of SDV. 50 lakh. That means 5 crore worth of property I have got. Plus cash I have got 1 crore. That means we have got 6 crore rupees. So what will be if I sell one flat? My question was, full value of consideration is 80 lakh. What will be the cost of acquisition? Is it going to be SDV of each flat 50 lakh? Or is it be total consideration 6 crore divided by 10, that is 60 lakh? What should be my answer? What should be? My opinion is 50 lakh. Why I am saying that? Why I am saying that? Just let us change the example and I say I am only receiving one flat. I am just receiving one flat. And sorry, one flat, and I am receiving 6 crore as cash. Or I should say two flats and I am receiving 6 crore as cash. Or 5 crore to be very specific. 5 crore as cash. Sorry. Two flats of 50 lakh SDV. 1 crore I am receiving. And 5 crore I am receiving in cash. Entire consideration is same. Now you think logically, if I am selling one flat at 80 lakh rupees, do you think that my cost of acquisition should be 3 crore for this? You tell. I am not saying anything. According to your explanation of 60 lakh, your entire consideration divided by number of two flats, that means cost of acquisition should be 3 crore. I am not saying anything, but yeah, you only said. You said total consideration divided by total number of flats. Take that as cost of acquisition. I am doing the same thing. I received two flats. Entire assets have been received of 6 crore. So divide by 2. My cost should be 3 crore. Is it justified even a bit? Your flats SDV is 50 lakh. You can be able to sell it at 80 lakh rupees. How come you will get cost benefit of 3 crore? How come? Let us take an example to the contrary. For example, you received one flat of 50 lakh SDV. 50 lakh plus you received 5.5 crore in cash. That means 6 crore you receive. Now, if you sell this flat for 90 lakh rupees, your cost of acquisition according to you should be 6 crore. According to your cost of acquisition should be 6 crore. Is it justified? The same logic that you are trying to put, I am trying to put in this case, but logic is not logicking. Got it? Logic is not logicking here. Okay? Did you understand what do I mean? See, logic will not logic here. Okay? Logical is this only that take the SDV. Logical is this only that you should take SDV only. If you start taking total consideration, it is possible that total consideration might have very big chunk of cash. That does not justify the actual cost. The actual cost will be the SDV of the flat only. Okay? I hope that clarifies. Somebody who has any doubt? Somebody having any doubt? Yes, sir. Got it. Coming on to the entire chart again. Sir, we have seen this chart so many times that sometimes we get frustrated. Arey, shut up. You cannot get frustrated on this. Focus on this chart. We did tax rates as well. 1128, 111A, 112, and exception also we did. We also did indexation concept as well. Then at last, sir, what we did? Sir, we did exceptions to 45(1). We also did these 4 cases. Now we have something extra to be studied, but before something extra, I want you all to focus on the exempt transfer. Come on to exempt transfer. We'll study this from book only. Exempt transfer. Section 47. If we recall, what is transfer? Sir, we studied any kind of sale, exchange, relinquishment, extinguishment, any compulsory acquisition, any kind of conversion of capital asset into stock and trade, any kind of handing over of immovable property in part performance of the contract, any kind of transaction. Any kind of transaction which has an impact of enabling the enjoyment of immovable property, and any redemption of zero coupon bond amounts to transfer. This was the basic definition of transfer. तुषार ढींगड़ा, सर मॉडल टैक्स कन्वेंशन में कोई चेंजेस तो नहीं है? सफल बैच, नो चेंजेस इन मॉडल टैक्स कन्वेंशंस, जीरो चेंजेस इन मॉडल टैक्स कन्वेंशंस. ठीक है? गोकुल, is 50C applicable to section 45 transfer? Every 45 transfer is 50C is applicable, na? 50C is applicable to across capital gains, but only on immovable property. Are you speaking about 47 transfers or 45 transfer? These transfers should have been taxed. These transfers should have been taxed. But somehow now we have to exempt them. There is a reason somehow we have to exempt them. Why? Because it is not reasonable enough to tax these transactions. I mean, see, based on the definition of the transfer, now there are a lot of things being covered. Now we cannot tax everything. Now some things are to be left aside for future. So we have to leave those things for future. Some things are to be left. And these section 47 list down those items only which cannot be taxed. This has to be left for future, and that is why this have to be kept aside. Now, what the section 47 speaks, certain transactions which are not regarded as transfer. Sir, compulsory acquisition as consideration is determined by the government itself. Acha, these 45 you are saying. See, compulsory acquisition SDV. See, normally government never pays amount lesser than SDV. Government doesn't pay any amount lesser than SDV. Normally, government never pays any sum lesser than SDV. SDV is at least paid by the government. But honestly, why the argument arises? Argument arises because SDV doesn't reflect the true value of the property sometimes. If you are using a property which is yielding you 5 to 10 crore rupees a year, SDV might be 1 crore only. Na? So SDV not actually reflects the property. There are properties in nearby station areas which are on lease. If you find out the value of the properties, now these are nominal. Rent on these assets are nominal. But the value that is being created from that is way more than that. Therefore, this argument arises. Okay, so government always pays amount with the SDV only. It never pays lesser than SDV. And the issue here is, what is SDV? Just tell me, Gokul, how SDV is determined? Do you even know how SDV is determined? How stamp duty value is determined? If you go to local collectorate, you will understand how SDV is being determined. It is just determined based on logical basis that last time transaction took place at this price, at this amount. That is why SDV should be this. SDV is nothing but a, I mean, there is no there is no single formula as to how SDV will be determined. If sale was done in recent past at a very higher price, SDV would increase of that area. If sale was done at very lower price, SDV would decrease of that area. So SDV is actually very subjective. So government might decide SDV for the area it is compulsorily acquiring. SDV is very subjective. In real life, you will find out. Section 47, transactions not regarded as transfer. Let's focus on the topic now. Okay. Distribution of capital asset on total or partial partition of HUF. For example, there is an HUF called AHUF. There are three persons, B, C, and D. D got adult, married, and separated from this HUF and started his new HUF, DHUF. Since he has been separated, he would receive his share of assets. Lawmaker says it is called partial partition of HUF. Any foregoing of the assets by HUF in partial partition, it shall be absolutely exempt. It shall be absolutely exempt. Sir, for example, there is person called AHUF. We have B, C, D. Now, A died. After a few years, people wanted to dissolve these. Their children wanted to dissolve this HUF. They transferred all the assets to their respective accounts. Lawmaker says that if there is total partition of HUF, entire HUF has been dissolved and entire assets have been transferred, so capital gain will not be applicable on the transfer of the assets by the AHUF to this. Transfer will not be applicable to these people. Okay. Transfer will not be applicable. So bottom line is, if distribution of capital asset on total partition or partial partition, it is not taxable. Government will not charge any taxes on this. Okay. Second thing, transfer of gift will by individual HUF. For example, I decided that if somebody scores 85 plus marks in DT class in this upcoming November 26 attempt, if anybody of you scores 85 plus marks, I will give you a gold chain. I'm not wearing any, but I will give you gold chain, a promise from my side. Now, if I gift you gold chain, will there be any capital gain on my hands? Lawmaker says that you are gifting anything. Gifting doesn't amount to transfer. Gifting doesn't amount to transfer. So if you are gifting the gold chain, according in your hands, it will not be any capital gain. It will not be any capital gain. The person receiving can take care of himself, but for me, it will not be capital gain. Any gift by individual HUF or any transfer of assets under will by individual HUF will not amount to transfer. Sir, done. Very, very, very well done. Very carefully listen. Very carefully listen. Very carefully listen. This is an important provision. This is a parent company. And this is wholly owned subsidiary. Wholly owned subsidiary means 100% shares are being held by the parent company. Lawmaker says that if any capital asset are transferred by parent company to wholly owned subsidiary, or if wholly owned subsidiary transfers any capital asset to 100% parent, this is an exempt transfer. Very carefully listen. Exempt transfer. If any asset is transferred by wholly owned subsidiary to parent or parent to wholly owned subsidiary, it shall be exempt transfer. Provided. What is that provided? First of all, recipient should be Indian company. Recipient should be Indian company. Non-resident should not receive any assets. Recipient should be Indian. Okay. Parent subsidiary, 100% relation should continue up to 8 years from date of transfer. If transfer took place on 1st April 2025, so for at least 8 years, there should be parent subsidiary relationship, 100% relationship, not even 1%. Not even 1% change, 100% parent subsidiary relationship should continue for 8 years. I cannot even sell, parent cannot sell even 1% share of the subsidiary. Otherwise, this will become taxable. Now, listen, third point. Recipient should not convert such capital asset into stock in trade up within 8 years from date of transfer. Whenever this asset is being transferred to the recipient now, such recipient shall not convert it into stock in trade. See, these exemptions have been given for capital assets. For stock in trade, no exemptions are given. So in this case, if any asset is being transferred to wholly owned subsidiary, now subsidiary should not convert it as capital asset. Sorry, it should not convert it to stock in trade for 8 years. Sir, if all the conditions are fulfilled, the transfer by parent to subsidiary or subsidiary to parent, it shall be absolutely exempt. It shall be absolutely exempt. But if any condition is violated, if any condition is violated, lawmaker says, listen, now very carefully listen. Tax will be charged in hands of transferor in year of transfer. Oh my God! That means, for example, if parent gave an asset to subsidiary, for example, a land to subsidiary on 1st April 2021, and wholly owned subsidiary converted this land into stock in trade on 1st April 2025, converted to stock in trade. Lawmaker says the tax will be charged in the hands of the parent only. And standing in 2025, tax will be charged in 2021. So tax will be charged in the year in which transfer took place. Listen, remember, this is very careful, critical point. Transfer tax will be charged in the year in which transfer took place and in the hands of the person who was actually transferring. So subsidiary will have no consequences, but transfer will be capital gain will be taxed in the hands of the transferor in the year in which transfer took place. This is the entire exemption. Let me read it out for you. If company transfers any capital asset to subsidiary of such company or subsidiary of such company transfers any capital asset to the parent, any transfer of capital asset between the two companies holding an 100% Indian subsidiary shall not be regarded as transfer. Of course, we do not include stock in trade because if we transfer stock in trade, it would not be capital asset. Capital gain provisions might not be applicable in stock in trade. Provided recipient is a transferor. In case holding company ceases to be 100% holding in subsidiary, holding and subsidiary relationship 100% does not exist, or such capital asset is converted into stock in trade by the stock in trade by the transferor company within 8 years from the date of transfer, then exemption shall be withdrawn and tax will be charged in the year in the hands of the transferor in the previous year in which transfer took place. This is the entire section for you all. Very important section. Very important. Clear to you all? Clear to you all? I want you all to come on to a question. I don't want to solve that for you. I'll solve question answers today. Whatever question I had given yesterday, I'll solve that as well. But I want to give you a question as homework. Question number 13. I want to give you as homework. I want to solve it with you. I'm desperate to solve it with you. I'm willing to solve this question for you with you. But issue is I want to give it as homework because I want to give it a try, give you a trial. So I'm giving you as DPQ. If time warrants towards the end of the day, we'll solve it today. If time doesn't warrant, do it today. We'll solve it tomorrow in the class. Question number 13, A limited as DPQ. Same question. Day 4, DPQ second. Question number 13 of Super 150, A Limited, cap gain. Gotcha? Now, sir, moving further, transfer in case of amalgamation and demerger. Very critical points, very critical points. ठीक है? In case of amalgamation. Just for a second, I am asking, are you all right now? Awoke? You are awakened? Not sleeping at all? Nothing? No doubt about anything? Just I am asking for a second. Nobody having any doubt up to this point? Not sleeping? Absolutely awake? Just confirm me. So not sleeping, sir, not sleeping. I'm not sleeping. We are not sleeping. Absolutely, we are not sleeping. Now, what is this amalgamation? See, if two companies merge, X plus Y, and they become Z, this is called amalgamation. See, in morning now, when I teach a lot of topics or I teach in-depth topics now, I personally think that morning is an area where anybody can sleep so easily. But you cannot sleep. We have very important topic under discussion. Okay, very important topic is going on. If X plus Y combine together and become Z, in that case, yes, sir, awake, 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 awake. Yes, sir, we are awake. This is called amalgamation. Sometimes X plus Y become XY. This is called joint venture. I am not aware. Okay, this is your accounts talking. This is not your income tax talking. This is your accounts talking. This is joint venture. Sometimes X plus Y become X, or sometimes X plus Y become Y, and these are called absorption. I don't know. This is absorption, I guess. Under income tax now, we do not understand these terms. We call all of them as amalgamation. Everything is amalgamation according to us. Okay. According to income tax, now everything is called amalgamation. We do not consider these four different terms as different. These are all amalgamation according to us. Now, under amalgamation, if you see, classic example of amalgamation was in recent times was Blinkit and Zomato. Blinkit and Zomato was the classic example. If you remember, Blinkit is a company which amalgamated itself to Zomato. Blinkit is a quick commerce company, amalgamated itself with Zomato. So there were multiple assets with the Blinkit, if you know. Blinkit had their dark stores. Blinkit had their inventory piled up. Blinkit had their creators. Blinkit had their daters. Blinkit had multiple other assets, licenses, some riders, multiple assets it had. And all the assets were transferred to Zomato, and in return, there were certain. Actually, no money was received, but shareholders of the Blinkit got the shareholders of shares of Zomato. So this was amalgamation, classic example of amalgamation. There is a lot of transfer happening, in this amalgamation. This will be exempt if it is a valid amalgamation. Now, what is a valid amalgamation? That is important. Listen, what is a valid amalgamation? Listen, if merger of two or more companies with another company, or merger of two or more companies to form one company, in that case, all the assets and liabilities of amalgamating company become the assets and liabilities of the amalgamated company. Lawmaker says that all the assets and liabilities of these Blinkit becomes asset liabilities of Zomato. Acha. Shareholders holding 75% minimum in value of the shares of amalgamating company become the shareholders of the amalgamating company. That means anybody who is holding shares of Blinkit, at least 75% of such people should be allotted shares of Zomato and not cash. Then this is a valid amalgamation. As per income tax, it is a valid amalgamation. Now, if it is a valid amalgamation, there would be exempt, there would be transfer happening of in case of a lot of things. Everything will be exempt. Let me tell that. Let me tell that. For example, we have Blinkit amalgamating with Zomato. Now, every asset transferred to Zomato should be actually transfer, it should be charged to taxes. Lawmaker says we are very clear, any transfer of capital asset by amalgamating company to amalgamated company is absolutely exempt. Any transfer of capital asset by amalgamating company to amalgamated company is absolutely exempt. Absolutely exempt. Okay, this is first exemption. Just think of it. Just think of it from viewpoint of shareholders. If Blinkit has a shareholder like me, my shares are taken away. If I have shares of Blinkit, my shares of Blinkit are taken away. And in return, forcefully, I have been given shares of Zomato. My shares of Blinkit have been taken away, and I have been forcefully given shares of Zomato. Forcefully. Whatever it is, sir, if there is amalgamation happening, it is a transfer. If my shares have been gone, there is extinguishment of rights in the shares of Blinkit. I got forcefully Zomato. In this case, there shall also be exempt transfer. So assets transferred to newer company is also exempt. Shareholders surrendering their shares in the old company to get the shares of the new company shall also be exempt. Fine, sir? Absolutely fine. Third thing is something typical, not actually not usual, but something typical. What it says, for example, as of now, if you are aware, Geo, Geo has a shareholder called Facebook as of now. Facebook has 10% shareholding in Geo. If you know, you know. If you don't know, you should know. 10% of the shares of the Geo are held by Facebook as of now. This is not Geo Financial Services. This is actually Geo Retail. No, sorry, Geo Communications. Geo, the telecom network we have, that Geo are being held by Facebook. One day, Facebook decided to amalgamate itself with Meta. Facebook doesn't want to live of its own. It decided to amalgamate itself with Meta. And they became single company called Meta. Now just think of it. Earlier shares were held by Facebook. 10% shares were held by Facebook. Now these 10% shares have been held by Meta. There is change in ownership because of amalgamation. Two foreign companies amalgamating with each other, and in amalgamation, transfer of Indian shares are happening. Oh my God. If two foreign companies are amalgamating, transfer of Indian shares is happening now. So in that case, lawmaker says it is an exempt transfer. Transfers of shares of Indian company. In case of amalgamation between the foreign companies, it is exempt transfer. Yes, provided at least 25% of the shareholders continue to be shareholders in the foreign company, that is not relevant. But if there is transfer happening between, if there's amalgamation happening between two country companies, na, it shall be absolutely exempt transfer. Okay? At last, any transfer of capital asset between banking companies. If you remember a few years back, na, there happened an amalgamation. Vijaya Bank, there was a Vijaya Bank, there was a bank called Corporation Bank, and there was a bank called Union Bank. All three of them combined together became Union Bank. All three of them combined and became Union Bank. Lawmaker says amalgamation should have been as per Banking Regulation Act. Any transfer of assets in under these Banking Regulation Act shall be exempt. So Vijaya Bank gave up all the assets. Corporation Bank gave up all the assets. This also bank gave up all the assets. In this case, the entire amalgamation was exempt, absolutely exempt. Okay, if this was as per Banking Regulation Act, these are the transfers under amalgamation that shall be absolutely exempt. Simple thing it was. Simple provisions. Demerger. Demerger, we have what is a valid demerger we need to understand first, and what are the exemptions that are available in demerger we need to understand. Listen very carefully. Demerger is something technical. Now, if there is a company called Reliance and a company demerges from it called Geo Financial Services. In this case, now we have two components. First of all is demerged company. Deepak, we'll cover that. We'll cover here demerger. In demerger also we shall cover the same example. We shall cover the same example. Demerger also we have the same example. I'll cover that. Reliance, since it is being demerged, so it is demerged entity. Geo Financial Services is a resulting company. Okay. In demerger, there is a lot of transfer happening. A lot of transfer happen in demerger. Now, this shall be exempt transfer provided. This shall be exempt transfer provided five conditions are fulfilled. I'm not requesting you to learn those five conditions, but listen to these five conditions very carefully. Assets and liabilities from Reliance shall become assets and liabilities of Jio. Assets liabilities from Reliance shall become assets liabilities of Jio. This is first thing. This is first thing. All assets and liabilities should be recorded at book value. Okay. All assets liabilities should have been recorded at book value. Okay. But sir, how is it possible if this company follows Ind AS? As per Ind AS, we have to record assets at market value. How come is it possible? Income tax is as per book value, but as per Ind AS, we have to we have to record them as per market value. Na? In Ind AS, you have studied this under 103. Whenever amalgamation take place, whenever demerger take place, assets are recorded at market value. And how come lawmaker says, "Acha, if resulting company follows Ind AS, company follows Ind AS, then assets liabilities can be recorded at values as per Ind AS." Okay, you don't have to write these things. These are I'm writing so that you focus well. Third thing, sir, Reliance gave up all the assets and liabilities, and what it got in return, lawmaker says that demerged company should not get anything other than shares of the resulting company. Reliance should get only shares of Jio Financial Services, GFS, and nothing else. Nothing else should be given. Only shares of Jio Financial Services should be given. Nothing else. Okay. Fourth thing, sir, at least 75% of shareholders of Reliance shall become shareholders of Jio, GFS. Whoever are holding shares in Reliance 100%, at least shall hold 75% of the shares of the Jio. Fair enough. Last, sir, transfer should be on going concern basis. It should be on going concern basis. A dead business should not be transferred. A going concern business, active business should be transferred. If all the five conditions are fulfilled now, then the demerger is a valid demerger. Otherwise, it will be taxable. Five conditions are to be fulfilled. What five conditions? Let me read that out to you. Demerger means transfer by demerged company to one of its undertaking as resulting company. The all conditions should be fulfilled. Assets liabilities of undertaking transferred by the demerged company shall become assets liabilities of resulting company. Assets liabilities shall become assets liabilities. All assets liabilities shall be transferred at book value. But if company follows Ind AS, then they might be recorded at Ind AS. The resulting company issues shares to the demerged company in the proportion of the assets. In return, Reliance should only get shares, nothing else. At least 75% of the shareholders become shareholders in resulting company, and at last the transfer should be on going concern basis. If all the conditions are fulfilled, then it is an exempt transfer. Okay. Sir, we understood it is an exempt transfer, but actually what exemptions do we get? This is Reliance and this is Jio Financial Services. Now, Reliance had assets of 1000 crore. Out of that, 100 crore assets are transferred to Jio Financial Services. Since assets are being transferred, this should have been transferred in the hands of Reliance. Lawmaker says it is exempt. If demerged company transfers any asset to resulting company, it is an exempt transfer. No tax would arise in the hands of Reliance. No tax would be arise. Okay. Second thing, if Rahul, for example, had 1,000 shares of Reliance acquired at 1,500 each. If I had 1,000 shares of 1,500 each, can I say demerger would part my assets into two parts? Part my assets. There will be partition of assets because my assets of 1,500 would become 1,350 and I would get free of cost 150 worth of new shares. There is partition of assets happening. Lawmaker says even though partition amounts to transfer, this will be an exempt transfer. So partition of assets happening, that is exempt transfer. These two transfers would be basically exempt. Sir, transfer of the capital asset by demerged company to resulting company if resulting company is Indian company. Surrender of the shareholders by the shareholders of the demerged company for receiving shares of the resulting company, that shall also be exempt transfer. Now, third thing, listen. Earlier we took an example like we have Jio in India, and India Jio's 10% shares are held by Facebook. Facebook itself merges with Meta. Can I say there is amalgamation of two foreign companies happening? Can I say that there is amalgamation of two foreign companies happening? Yes. Amalgamation of two foreign companies happening, but there is actual transfer of Indian company happening. Earlier, shares of Facebook were held, shares of Jio were held by Facebook. Now, in amalgamation, Meta became the owner. So there is transfer of assets now during amalgamation, transfer of Indian assets during amalgamation. There is actually transfer happening in case of amalgamation of two foreign companies. Indian assets are being transferred. In case of amalgamation, lawmaker says this should ideally be exempt. This should ideally be exempt. If two foreign companies amalgamate with each other and there is transfer of Indian company happening, it should be exempt transfer. In addition to that, listen very carefully. Sir, later on, Meta has, now since Facebook merged with Meta, now Meta has 10% shares of Jio. Meta has now 10% shares of Jio. Now one day Facebook wants to separate itself again. Facebook again wants to separate itself. Now Facebook want to again demerge. And lawmaker says now Facebook want the shares of the Jio. So again, demerger would transfer the shares from Meta to Facebook now. In demerger, if demerger would happen again, shares of Facebook, shares of Jio would again come to Facebook. Shares of Jio would again come to Facebook. Again, there is demerger happening between the foreign companies. So bottom line is, if Indian company is there and demerger is happening between two foreign companies, if amalgamation is happening between two foreign companies, then it shall amount to exempt transfer. This is what the entire provision of exempt transfer is. If demerger is happening between two foreign companies, Indian assets are being transferred, it shall amount to exempt transfer. If amalgamation happens between two foreign companies and Indian assets are being transferred, it shall also amount to exempt transfer if this is a valid amalgamation. Clocked it. Oh, this is a new terminology trading. I mean happening. Did this point clogged it to your brain? Did this terminology clogged it to your brain? Sir, we got this point. Fairly, we understood these provisions. We understood. This was easy. This wasn't difficult. Okay, these were exempt transfer. This was actually the fifth exempt transfer. Fifth. These were 5 exempt transfers. We have certain more. Now we shall try to make it more engaging. Okay? These were relatively difficult. Now we'll make it simple. Okay? We will make them simple. First of all, redemption of sovereign gold bonds by individual assessing. Now, you know what sovereign gold bonds are? You know what sovereign gold bonds are? Have you ever heard of this thing? Sir, in 2000, it was 2018, 17, 19, when government felt that people are investing a lot of their money in gold. Now, what happens if you buy gold now? Money is locked there, and that gold is being preserved in the almirah, in the locker. It is of no use of the industry. It is no use of the economy. Just more and more money is being blocked in the gold. Nothing happens. Correct. In this case now, government is very tensed that if people buy more and more gold, our import bill will rise more. So at that point of time, the government came up with certain bonds. Now, what were these bonds? Let me tell you. For example, if gold price is trading at say 4,000 rupees. At that time, the 4,000 was per gram rate. So instead of actually buying 1 gram of gold, you could have simply bought 4,000 rupees per gram of bond. One bond you could buy. Now, what was the benefit of this gold bond? As soon as the gold prices rise, as soon as gold prices rise, your gold bond would also rise. For example, as of now, if gold price is 14,500, so your bond would also be 14,500. If gold prices rise by 100%, gold bonds would also rise by 100%. Now, what benefit you have in gold bonds? Personally speaking, no making charges. If you buy gold, then making charges are applicable. Sometimes, if you buy gold, GST is also applicable. No GST on this. Sir, there are multiple brokerages. Whenever you buy gold now, via some exchanges, then there are no, sorry. If you buy gold via a jeweler, purity issues there. Here we don't have purity issues. This is the price of actual gold. When you sell gold, you used to have capital gain and tax at the rate of 12.5%. Lawmakers here gave an option that if you are an individual SSC and you redeem this gold bond till maturity, you hold this till maturity and redeem it on the time at the time of maturity, there will be no capital gain in your hands. So capital gain is also saved. In addition to that, believe me, like gold carries certain charges with itself. If you want to buy gold, you'll not keep this gold in your home now. You might keep it at locker as well. There is risk issue involved. There are locker charges as well. In this case now, in gold bond, what it happens, you will get interest at the rate of 2.5% per annum. You would get interest as well. In addition to that, if gold is available at 4,000 rupees per gram, this gold bond were available at 50 rupees, 100 rupees discount, maybe 3,900, 3,950. So these gold bonds were very beneficial. When they were issued now, they were nothing but blessing in disguise for those who actually want to invest in gold. These were blessing in disguise for those people. But issue involved is there is no underlying backing now. I mean, government is forcing you to buy gold. Government is forcing you to buy bonds, but government has to pay now. Ultimately, if government is giving these bonds, government might have to pay the money back to the people. Now, government received just 44,000 rupees per gram, but as of now, they have to pay 14,500. Nearly 1.5 lakh crore is the outstanding debt on these gold bonds. How they will pay up, I don't know. I personally don't know how government is going to pay up. But this gold bond has been literally critical. Government doesn't know how to proceed. Government doesn't know how to pay off. But yes, they have outstanding liability, and government has to pay in upcoming year. So this is, let's see how it happens. But see, this happens. The karma is something very dangerous. When Nirmala Sitharaman ji became finance minister now, she said, I cannot decrease the price of the petrol because now I have gold bonds. Sorry, I have petrol bonds outstanding debt. Tai said we have outstanding petrol bonds. At that time, oil bonds were issued under UPA government, under Manmohan Singh government. Oil bonds were issued because of which there was too much debt on the current government. Now, current government has issued gold bonds. Now, this will leave a debt on upcoming government. So, every government who comes there during their tenure now has a habit of blaming on the other people, and they ultimately do the same thing. Just think if some other government come into picture. Let us suppose in future some other government would come into picture. They would blame the current government. Like Tai raised the gold bonds and now gold bonds are outstanding 1.5 lakh crore. How they are being paid? How they'll be paid? This happens, but as of now, this is actually a serious issue with the government. How they are going to repay this debt? This is a serious issue for us. Important point is redemption of sovereign gold bond by individual SSC is absolutely exempt. Individual SSC might hold it to maturity, it will be exempt. If individual transfers before maturity, it will be capital gain. Any other SSC might transfer it at the time of maturity or before maturity, capital gain would arise. Interest on gold bond is absolutely taxable. Interest on gold bond is absolutely taxable. Got it? Just mention the word clear now so that I am aware that you are not sleeping. Just continuously mention the word clear so that I am aware you are not sleeping. Okay? You know what? One day, I was sitting idle. This is a real life instance. Real life instance, I'm telling you. One day I was sitting idle and I wanted to draw a painting. So instead of Instead of getting an idea, what I did, I just took a brush and just to draw this way, just to draw a vertical U. Sir, it looks like a bell. No, no, it's not a bell. I made this thing and I joined it this way, made a circle, two eyes, and this a smile. You know what? There would be Mona Lisa in Italy, made by Leonardo da Vinci. Made by Leonardo da Vinci, beautiful Mona Lisa painting might be in Italy. We made our homemade Indian Mona Lisa and named her Sona Lisa. Oh, we made a painting, beautiful painting, exuberant painting named Sona Lisa. The eyes she has a kind of sparkle in her. The hair she has, beautiful textured hair. The smile she has a different kind of silence in her smile. The ear, the nose, the overall expression is just so calming that people just looking at Sona Lisa would be just flattered. Just looking at Sona Lisa would be flattered. Array, there was a wait. I mean, I just clicked the image of Sona Lisa and uploaded on Instagram. There were 500 million views. 500 million views. 50 crore people watched Sona Lisa. They were crazy to watch Sona Lisa. They were crazy to watch Sona Lisa. Everybody was, I mean, what do I say? Everybody wanted to just watch Sona Lisa. Oh my God. People were like crazy to watch Sona Lisa. All of a sudden, I received a phone call. I am personally telling you, I received a phone call from Ambani ji. Ambani ji said, Rahul, you are my brother-like person. Can you give the Sona Lisa to me? I'll pay you 100 crore rupees. On the other hand, Adani ji called. Adani ji said, Rahul, we both belong to same community. You are Sindhi, I am Marwadi. We both do businesses. Can you sell the Sona Lisa to me? I'll give you 80 crore rupees. Mittal Saab said, we'll give you Sona, we'll give you 110 crore for Sona Lisa. Even Modi ji called. Modi ji. He said, friends, I mean, sorry, Rahul ji, we have old relations with Sindhi. Sindhi people are very close to us, very old relation to Sindhi people. Government of India can pay you 20 lakh rupees. Just give the Sona Lisa painting to us. Out of generosity. Out of generosity, what we did? Out of generosity, what I did, I gave this painting to a national museum. See, I gave this painting to National Museum. Out of nowhere, I gave this painting to National Museum. I received 10 lakh rupees in return, nothing else, just a 10 lakh rupees in return. Shouldn't this be taxed in my hands? Should this be taxed in my hands or shouldn't this be taxed in my hands? What should be the case? Should this 10 lakh be taxed in my hands? I have given up hundreds of crores that I was about to receive. Hundreds of crores that I was about to receive, I had to give up. Should this be taxed in my hands? Lawmaker says, no, 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 dear, no. If you transfer any work of art, if you transfer any archaeological asset, if you transfer any manuscript, if you transfer any book, photograph, or print to government, university, national museum, art gallery, art archive, etc., if you transfer them, it will be absolutely exempt in your hands. It will be exempt transfer. No provisions of any capital gain are going to arise in your hands. No capital gain arising in your hands. Gotcha. Sir, we got this point. Okay? We got this point. There is nothing difficult in this. Simple provisions are going. We got this point. Okay? Now, listen the next example. For example, this is Rahul. As of now, my age is 70. Sir, yesterday you were 22, now today 70. Array, my age changes with the examples. I have 7 children and all abroad. All abroad. They never call me, they never ask me, they never come to India, they never meet me. All 7 children, no touch. As of now, I am just staying alone, just teaching you all. I have nothing to do. I just teach to students. I have one house. But the problem is, how will I eat? How will I eat? I want to eat now. You are not sharing this class with other people. You are not sharing with this class with other people. How can I mean, I want some money, na? I want some money to survive. If you will not share, how will I survive? So I want some money to stay. So what do? I have just one house and I have no other source of income. What can I do? I gave this house. I gave this house to a bank and requested bank and said to bank, just listen. Na. I just went to bank and said this bank, listen. Na. I am giving up my house to you. I want 70,000 rupees per month. I want to get 70,000 rupees per month till I die. Oh. Now, bank would also assume that how much would be my life, 70,000 per month, which means 8,40,000 rupees for 1 year. I might die in 5 years. Example. So it would be 42 lakhs. So bank thinks yes, it is reasonable enough to pay. Bank agreed. Now every month bank is giving me certain money. Isn't it something very strange? Whenever I buy house, I have to take money from bank and I have to pay every month installment. This is what happens now. If I buy a house, I take loan from bank and I pay them every month. But here what is happening? I have a house, I have mortgaged it with bank and I am getting every month installment. I am getting EMI. So can I say it is a kind of reverse mortgage? Yes, this is a reverse mortgage. What happens, sir? In this case, I have not transferred the asset now, but I am receiving EMIs. Once person dies, in that case, this asset would become property of the bank. This is called reverse mortgage scheme. Now, what transfer reverse mortgage schemes case is? Ultimately, sooner or later, this bank is going to be the property of this house is going to be property of bank. This house would go to bank. Sooner or later, this is going to happen. So lawmaker says if this becomes property of the bank, then what would happen? It will be exempt transfer in the hands of Rahul. Exempt transfer. Whatever money that I receive now, whatever money that I receive as EMI, every month installment that I am receiving. Wow, so nice. I am receiving EMI. I am not paying, but I am receiving EMI. So whatever EMI that I receive now, that will be exempt in my hands. Any money received under reverse mortgage scheme is exempt. So any transfer of house is also exempt. Any transfer of capital asset under reverse mortgage scheme is exempt. Another example. Another example. Try understanding this example and answer. Okay, this is the question which you have to answer. For example, we have with us Krishna. Krishna knows that in 5 days now, shares of Reliance are going to shot up by 30%. 5 days shares of Reliance are about to rise. About to rise by 30%. Somehow Krishna has got this insider information that shares of Reliance are going to rise up by 30%. Now, what Krishna can do to take benefit of these? What Krishna can do to take a benefit of this? What Krishna can do? What Krishna can do? Just think. Just think. Sir, he will buy shares. Of course, he will buy shares. If Krishna thinks that it is going to rise, he is going to buy. I think it's not Krishna, it's Lavanya, I guess, if I'm not mistaken. Now, if Krishna thinks that he is going to get benefit, he is going to buy the shares. If I ask you, he doesn't have money. He doesn't have money to buy the shares. What he will do? What he is going to do? Sir, he is going to take loan and then buy shares. If he thinks that actually he is going to get benefit, he is going to take loan and buy the shares. Correct? That is what happens now. So ultimately, with the upcoming wave, he is just going to buy shares, hold them, and sell when they are high. This is what he's going to do now. So he's going to do that. But sir, what if Krishna thinks that Reliance shares are going to fall by 10%? Reliance shares are going to fall by 10%. There is going to be fall. Now, how Krishna can benefit from this? How Krishna can benefit from this downward fall? See, for upward fall, it is very easy to buy shares. Buy shares. You don't have money, take loan and buy the shares. Hold them for 5 days and sell it later on. If you know what is going to happen, in case of upward movement, you can simply buy them. But if you know if downward movement is going to happen, what can you do? You cannot actually, you don't have shares. How are you going to benefit from them? So in this case, yes, sir, Slavanya, perfect. Now, if you know that you are going to, if you know that shares are going to fall, how can you take benefit from him from this? You can short sell. You can short sell now, but short selling is only limited to intraday. Short selling is only limited to intraday trading. Beyond intraday, you cannot carry forward your position. Sir, and we might go for futures and options. So and options are not available on every securities. So there are limitations now. So what I do, sir, I would lend these, I would borrow these shares. For example, there is person called Deepak. Deepak has 1,000 shares of Reliance acquired for 1,500. He lent these shares to Krishna. He lent these shares for Krishna. Krishna immediately borrowed them, sold them for 1,500, received 1,500. After 5 days of fall, the share price were at 1,100 and Krishna again bought them. Krishna bought them for 1,100. So ultimately, he has a benefit of 400 rupees. Krishna got a benefit of 400 rupees. He would buy these shares and return to Deepak. Deepak earlier had 1,000 shares. Again, also he has 1,000 shares. He has nothing to lose. Deepak has nothing to lose. But Krishna took the advantage of the downward movement and earned 400 rupees. This is actually the stock lending scheme. Not everybody can do in stock market. But finally, a benefit here is, and understand, Deepak gave up his right to sell to Krishna now. Understand, if you have any assets, if you are giving up the right to sell, if Deepak is giving up his right to sell to Krishna, it is a kind of transfer happening now. If I have an asset and I give you that asset and I give you right as well to sell these assets, to buy these assets, shouldn't this be transfer? If I have some assets, I have some shares and I am giving up those assets to you. And along with that, I am giving up the right to sell those assets as well. Shouldn't this be transfer? Lawmaker says, even if it is considered as transfer, even if it might be considered as transfer because of some remote connections, we will exempt this transfer. Stock lending scheme, whenever you transfer any asset, it shall absolutely be exempt. It shall be exempt. Transfer of shares under stock lending scheme is absolutely exempt. So any transfer between lender and borrower is exempt. Okay, Krishna buying and selling will definitely have capital gain, but the point is, for Deepak it would be an exempt transfer. SPV, hold for some time. We have not studied business trust. We shall study it after, later on, then only we'll be able to understand. If there is any predecessor cooperative bank succeeding to a new cooperative bank, one or two cooperative banks are merging, then any transfer would be exempt. Any infra company merging itself with any institution meant for financing, any public sector undertaking merging itself with another public sector undertaking. In case of business reorganization, succession happening, not relevant. We have two more important transfers. Listen this point also. Conversion of securities. If you have shares of a company, sorry, if you have debentures of a company, if you have bonds of a company, if you have debenture stocks of a company, and these debentures, deposits, bonds are transferred, are converted into shares of the same company. If I have shares or if I have bonds of Reliance and these bonds become shares later on, lawmaker says it is exempt transfer. If I have debentures of Reliance and these debentures become stocks of the shares of the Reliance, it shall also become exempt. So this conversion shall become exempt transfer. If I have preference shares of the company, I get equity shares, that shall also be exempt transfer. If I have physical gold and I convert them into digital gold via EGR, electronic gold receipts, by Vault Manager, it shall also be exempt transfers. Okay. Non-resident exemption we cannot do right now. This can be only done after NR taxation. Mutual fund related exempt transfer, I am teaching you right now. After break, I will teach you the companies. I'll give you break after this mutual fund related exempt transfer. What this says, for example, if a equity oriented mutual fund consolidates with equity oriented mutual fund, then it is exempt transfer. If a debt oriented mutual fund consolidates with a debt oriented mutual fund, it is also exempt transfer. But sir, if equity oriented mutual fund merges itself with debt oriented mutual fund, it is taxable transfer. ठीक है. How things go, let me tell with an example. For example, this is Rahul. Now I have mutual fund 100 units of 1000 NAV. Which one? Nippon India Classic Fund. Fine. Now Nippon India Classic Fund is working well, but Nippon people felt that they don't want to continue the Classic Fund, so they merged themselves with Nippon India Growth Fund. Nippon India Growth Fund, they merged. Growth Fund, they merged themselves. Earlier I had almost 1 lakh worth of shares. Now in this exchange, see, whenever there is merger happening, you have studied this in AFM that there is synergy benefit, there is reduced cost expense ratio. So against these 1 lakh units, I got fresh units, 100 units of new fund whose NAV is 100 1100 rupees. So my value of 1 lakh became 10 lakh. Oh, sorry, 1 lakh became 1 lakh 10,000. Whenever there is a consolidation of funds happening, there is merger of two equity oriented mutual funds happening, any kind of benefit arrived on account of such conversion shall be absolutely exempt. And this is a benefit I have got, this benefit shall be absolutely exempt. Got it? Same to same happens. For example, if there is Nippon India growth plan, sorry, Nippon India dividend plan. If we have dividend plan, I have 100 units of 1000 each, valued at 1 lakh. Later on, Nippon India dividend plan consolidated with Nippon India reinvestment plan. Nippon India reinvestment plan. In this case, what would happen? Sir, I would get 100 units of 1100 each. Here I have 1 lakh 10,000. Again, I have got a benefit of 10,000 rupees. Lawmaker says this is also exempt. So if two mutual fund consolidated with each other, then any transfer, any profit is absolutely exempt right now. If two debt-oriented mutual funds consolidate with each other, again that would be exempt. So inside a mutual fund, if two plans consolidate, now then too it shall be absolutely exempt to transfer. So consolidation of mutual fund is exempt in that sense. Okay. Moving further, in case of conversion of entities, do you just tell me, are you willing to continue it right now, or should I give a break and teach you later on? Should we continue it right away, or should we continue it after the break? Just confirm me right now. If you are willing to study, we can study it right now, or if you want break, we can give a break right away. If three people says a break, I'll give you break. Three people. Deepak says break. First break. 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 Sorry. Break. It is 8:16 till 8:30 plus minus 2 minutes. This is our vyavhar. Okay. Vyavhar, I hope you understand. This is our just relations, because of which I am giving you 2 minutes extra. Even if you come 2 minutes late, you will understand things. See you guys after the break. Welcome back from break. Dear beloved, are you back from break? Anji, are you all back from break? Sir, we never went to break. We were always sitting here. We never go to break. Our system is open. Meanwhile, we eat breakfast or whatever we do. Done, sir. We are back from break. Chalo. Conversion of entities, personally speaking, very important topic. Focus now. For example, if a sole proprietor wants to convert himself to a company, can he do so? Sir, he can do so. Sole proprietor wants to convert himself to a company. Can he do so? Sir, he can do so. Easily he can do so. But sir, he whatever assets he would be transferring to companies ideally should be taxable. It should attract a capital gain. Lawmaker says converting yourself to a company would be an exempt transfer provided you fulfill certain conditions. Okay? What are those conditions? Sir, all assets and liabilities of proprietorship firm should go to company. And that proprietor shall get nothing except shares. Nothing except shares. Basics. I am giving up all my assets to form a company and company should give me shares of its own. That's it. Third thing, 100% of the shares should be held by show proprietor. 100% shares should be allotted to proprietor. Oh, sir, that means this company would be one-person company. See, ideally it is not one-person company. If assets are being transferred, if entire assets are being transferred to the company, now you might get 99.999% shares. 1.001% shares can be allotted to somebody to fulfill the minimum company criteria, but majorly 100% shares should be held by you. One or two share can be held by other person to make the criteria fulfilled. Okay? Fourth thing, very important condition, very carefully listen, very important condition which people fail to understand. Listen. For example, Rahul proprietor became Rahul Private Limited. Yes. So this is what it happened. This is what happened. I have been allotted 100% shares. Sir, I have been allotted, fair enough. Can I sell these shares? Can I sell them? Sir, I can sell them. You might sell and reduce shareholding in the company. You might sell and made it 90. You might sell, make it 80. You might sell any number of shares. But lawmaker says within date of conversion, 5 years from date of conversion, 5 years from date of conversion, you should at least hold 50% of shares. Very important. 50% of shares should be held by you. Even if you want to sell now, that's okay. But up to 5 years, you can sell maximum 50%. You should hold 50% if you fail to do so. If you fail to do so, then in that case, exemption by proprietor shall be withdrawn and it shall be taxable in the hands of the company. Taxable for company in the year of violation. Did you understand this provision? Baba, did you understand this provision? If proprietor transfers all assets should go. In return, proprietor should get only the share capital of the company. Sir, he should be only shareholder of the company, and whatever shareholding he has, he should at least maintain 50% of the shareholding till 5 years. If he sold lesser than 5, if he holds lesser than 50% now, then exemption claimed earlier shall be taxable in the hands of the subsequent company. Gotcha, sir, gotcha. This is the first conversion of companies, first example of conversion of companies. Okay. Can a partnership firm convert itself into company? Sir, it can also convert. All the assets and liabilities of the firm shall be gone to company. That means there would be a lot of transfers happening. Provision says every transfer is an exempt transfer provided certain conditions are fulfilled. What are those conditions? First of all is All assets, liabilities shall go to company. Of firm should go to company. Oh, partners should get nothing but share capital. Partners should become shareholders. No other consideration. That means company should not pay you any money. Company should only issue you shares. That's the only basic difference. Should not. No other consideration. Sir, shareholding of partners shall be in ratio of capital contribution. Whatever your capital was in that ratio, na, you will have shareholding in the company. Reasonable enough. Fourth thing, important. Na? Fourth thing, sir, if you were partners in a firm and you became company's shareholders, can I say all 100% shares would be allotted to partners only? 100% shares of the company would be allotted to partners only? Yes, sir, yes. Can these partners sell their shareholding? For example, there were A, B, C, D. There were four partners and each were allotted 25%, 25%. All of them were also allotted 25%. Can they sell it? Right answer is yes, they can sell it. Any point of time, they can sell it. Today, tomorrow, day after tomorrow, anytime they can sell it. But lawmaker says once you have been allotted up to 5 years of date of conversion, maximum you can sell 50%, or I should say minimum you should hold 50%. Minimum 50% shareholding you should maintain. If you hold lesser than 50% now, exemption will be withdrawn. You should be holding minimum of 60%, minimum 50%. Otherwise, exemption will be withdrawn. And sir, whatever exemption was allowed to firm, that exemption will be withdrawn, and that withdrew exemption will be taxable for company if this 50% criteria is not met. Fair enough. Very simple case. Very simple case. Now listen, third case. Third case. Very simple case, but yet important. The third case. Can a company convert itself into LLP? Can a company convert itself into LLP? Sir, company can convert itself into LLP. It is absolutely allowed, but there are certain conditions attached to it. Not every company can convert, sir. First of all, unlisted company can only convert. Unlisted company can only convert. A listed company cannot convert itself into LLP. Unlisted company, first of all, which has gross receipts up to 60 lakh rupees in three preceding financial year. That means, for example, in previous year 25, 26, if a company wants to convert into LLP, it has to check its turnover in preceding 3 years. 24, 25, 23, 24, 20, 23. In all the 3 years, your gross receipt should not exceed 60 lakh. Your turnover, your revenue from operations should not exceed 60 lakh rupees. Then only you are eligible for conversion. Okay. Plus, in 3 preceding financial year, for any year, your assets should be up to 5 crore. At any point of time, your assets should not be more than 5 crore. That means small companies are allowed to convert themselves into LLP. Your assets should not be more than 5 crore. Second thing, your turnover in all the 3 years should be up to 60 lakh rupees. Then only such companies are allowed to get converted. Now, when these companies are allowed to get converted, there are certain conditions to be fulfilled by them. All the assets and liabilities of the company should go to firm. Should all the assets and liabilities of the company should go to firm. Second thing, whoever are the shareholders of company shall become partner in firm, partner in LLP. Third thing, sir, ratio of profit and capital contribution should be on basis of shareholding. Whatever shareholding you had, based on that shareholding, you will be allotted profit sharing ratio. Based on that, you will be allotted capital contribution. Sir, listen very carefully. For example, there were A, B, C, D, four shareholders. Each held 25%, each held 25%, each held 25%, each held 25%. All the shareholders became partners in LLP, and all of them have been allotted 25% profit sharing ratio. 25% of the profit, 25% of the profit, 25% of the profit, all of them have been allotted 25%. Lawmaker says, can they add new partners? Yes, they can add. Can some partners retire? Yes, they can retire. But lawmakers are very clear that all those partners who became, all those shareholders who became partners should continue to hold at least 50% of the profits up to 5 years from date of conversion. From date of conversion, you shall be holding at least 50% of the profits. You can have new people, you can retire the old people, but at least 50% of the profit should be held by you. Profit sharing ratio should be held by the original partners who became partners at the time of conversion, at least 50%. What if, sir, violation took place? Sir, if violation takes place, now in that case, whatever the exemption that was allowed to company, that shall be withdrawn and shall be taxable for LLP in the year of violation. In addition to that, sir, there is another condition with respect to conversion of LLP. Lawmaker says that, see, company has a basic structure. Company has a basic structure that whenever a company has a profit now, this profit can be taken out in the form of dividend only. If company has certain profits, these profits can be taken out from dividend only, in the form of dividend only. Listen, huh? For example, if there is a company and this company has balance sheet, oops, this is not going to help. If company has a balance sheet has reserves and surplus. Reserves and surplus are 2 crore rupees. Now, if you want to take this reserves out, you need to distribute dividend, then only you can take this reserves out. Basic condition of the company is, if you have reserves, if you want to take the reserves home, if you want to distribute these reserves to the shareholders, you have to distribute dividend. This is the basic condition. But sir, what if you convert yourself to LLP? Then this reserves would become free. This would become free for distribution. Lawmaker says no. As on the date of conversion into LLP, whatever free reserves you have, that cannot be distributed for at least 3 years. That cannot be distributed for at least 3 years. This is what the conditions are. No amount should be paid directly, indirectly to the partners from accumulated reserves standing on the date of conversion up to 3 years from the date of conversion. Up to 3 years, reserves cannot be distributed. Up to 5 years, profit sharing ratio has to be same. Consideration to the shareholders is nothing but profit. This is the profit that he should be getting. All assets and liabilities should go to LLP, and shareholders shall become partners in the ratio of their shareholding. Turnover of the company should be lesser than 60 lakh rupees in all preceding 3 years, and assets should be up to 5 crore rupees in preceding 3 financial years. Okay? In this case, unlisted public company shall be exempted. Converted to LLP shall be exempted. This is conversion of entities. This is entire conversion of entities for you all simplified, and this ultimately sums up to your exempt transfer. Sir, how many exempt transfer did we study? Just try to recall. If there is partition of HUF, we are giving up in the form of gifts. Transfer of assets by parent company to 100% subsidiary and vice versa. Then we had amalgamation, then we had demerger. These are 5 basic transfers we understood, which were in depth. Then redemption of sovereign gold bond we understood. We understood how reverse mortgage scheme works. We understood how stock lending scheme works. We understood how assets are transferred to library, National Library, art archives. 9 we understood. Then this is not relevant, this capital asset from old bank to new bank. Important was mutual fund. 10th, mutual fund consolidation is important. 11th was, sir, in case of conversion of entities. 12th was, sir, in case of conversion of securities. We also have NR tax, transfer in respect of NR taxation. We shall study this when we will study NR, non-resident taxation. We studied 12 or 13 or 14 exempt transfers. Important 14 exempt transfers. There is something more I want to add to your knowledge. Come on to board notes. I want you all to focus for next 15 to 20 minutes with full potential. What I do mean with this point. Some common pointers with respect to exempt transfer. Whatever exempt transfers we have understood now, every exempt transfer has such common points. Every exempt transfer shall have such common points. What common points do we have? I'm taking an example to illustrate you what I actually mean with this. Just try to participate. The more you participate, the better it will be for you to understand. I already know these points. I have already written these points million times. You just have to participate. Okay? For example, we have with us Mr. Gokul. Mr. Gokul purchased land on 1st April 2001 for 20 lakh. Fair enough. Fair enough. Very carefully listen. Very carefully. On 1st April 2008, he constructed building worth 25 lakh. 1st April 2012, gifted to his wife, Mrs. Gokul. 1st April 2018, wife constructed balcony worth 20 lakh. 1st April 2025, transferred to Mr. Deepak for 3 crore. Compute capital gain and taxes. This is not a question which I want you, which test anything. This question is not testing out anything. We have done much more difficult questions yesterday. This is not going to test anything. This question is this question will help us to understand and draw some conclusions. What conclusions? Let us understand one by one. How capital gain would be calculated? Full value of consideration we shall be taking. Capital gain will be computed in the hands of Mrs. Gokul, and previous year would be 25-26, assessment year 26-27. This is what is going to happen. Full value of consideration is going to be 3 crore. Transfer expenses are nothing, so no transfer expenses, and this will give us net consideration 300 lakh. I am writing 100 lakh so that it is easier for me to calculate. What will be the cost of acquisition for Mrs. Gokul? I want you all to participate. What will be the cost of acquisition for Mrs. Gokul? You already know this answer. We have done this yesterday. We have done this multiple number of times. We have also understood this multiple number of times. But I want you all to answer this thing. What will be the cost of acquisition for Mrs. Gokul? Just answer. Out of the given data, just answer. Cost of previous owner. Cost of previous owner. Deepak says indexed. Right answer is no, it will not be indexed because transfer is happening after 1st April 2025. Deepak, do not make this mistake. Transfer is happening after 23rd July. There will be no indexation happening. That means, can I say cost of the previous owner? Cost of previous owner. That means 20 lakh. Yes. Can I draw a conclusion that in case of exempt transfer, if somebody receives any asset on account of exempt transfer, cost of acquisition of the previous owner shall be taken? Will be cost of acquisition of previous owner. Can I draw this conclusion? That means in all the exempt transfers, we shall take the cost of acquisition of the previous owner. For example, if there is partition of HUF happening, then in that case, if I receive any asset in partition, then cost of acquisition of HUF shall be taken. In case of gift, if somebody gifts me any asset, cost of acquisition of the gift person shall be taken. If there is parent subsidiary transfer, if subsidiary receives any assets from the parent, then cost of acquisition of the parent shall be taken. If transfer happens in case of amalgamation, that means Blinkit gave assets to Zomato and Zomato is later on transferring. So cost of acquisition for Zomato will be cost of acquisition for the Blinkit. In case of demerger, if asset has been received from the parent company, then cost of acquisition of the parent shall be taken. Similarly, in case of conversion of securities, so conversion of assets, for example, if proprietor converted into company, so what will be cost of acquisition of the company? Cost of acquisition of the proprietor. In case of conversion of mutual funds, sir, consolidation of mutual funds, if I receive new mutual funds, cost of acquisition shall be taken as old only. If there is conversion of securities, I have debentures and those debentures are converted into shares. What will be cost of acquisition of shares? Cost of acquisition of the debentures. In every case, this is going to hold good that in case of every exempt transfer, cost of acquisition shall be taken as previous owner. Did we get this conclusion? Every exempt transfer that we have studied now, in all the cases, this holds good. This holds good. Got it? If asset is changing hands, then in that case, cost of acquisition for the new person shall be cost of acquisition of the previous owner. Is this clear? Sir, got it. Is this clear? Got it. Moving further. Cost of improvement. Sir, what will be the cost of improvement in the given case? What will be the cost of improvement in the given case? What will be the cost? Sir, it is clear. What will be the cost of improvement in the given case? Now answer. Yes, sir, clear. Yes, sir, clear. Yes, sir, clear. Sir, can we say cost of improvement will be cost of improvement of the old owner and cost of improvement of the new owner as well? Cost of improvement shall be taken. Niharika, oi, hoi, hoi, Niharika, hello. We are seeing you for the first time. Welcome. Now, cost of acquisition, we understood. Cost of improvement, what will be the cost of improvement? Sir, improvement done by previous owner as well, improvement done by the newer owner as well. So can I say improvement shall be cost of improvement of old owner plus new owner? That means 20 lakh was the construction done by 25 lakh was construction done by Mr. Gokul and 20 lakh was done by Mrs. Gokul. So 45 lakh will be the cost of improvement. Yes. Beautiful. Everybody answered beautifully. Done, sir. We got that. We will arrive at capital gain in this step. 300 lakh minus 65 lakh. Overall, our capital gain will be 235 lakh. Now, this will be, of course, long-term capital gain because in any case, it is being held for more than 2 years. But my question to all of you is, shall I consider period of holding from this date or from 2012 or from 2001? What shall be my period of holding in this case? What shall be the period of holding in case of Mrs. Gokul? Will that be counted from 2012 to 2025, that is 13 years? Or will that be counted from 1st April 2025, that is 25 years? What will be the period of holding in this case? What will be the period of holding in this case? So 2001, 2001. Deepak says 2001. Yes, sir, 2001 we shall be taking. Legally, it is correct. So we understood cost of acquisition. We understood cost of improvement. Cost of improvement of previous owner plus cost of improvement of new owner. Period of holding. period of holding from old owner shall be taken. Sir, we got it as per case law, correct? Now, my question to all of you is, it's actually not a question, but it is very relevant for us to understand the period of holding. Just imagine if this would have been 2000, if gift would have been given in 2024. Assume that this would have been 24. Then, if we might take this period of holding, we would get short-term capital asset. But if we take long period of holding, then we would have long-term capital asset. So, period of holding is really important in this case. You cannot just underestimate that it will always be long-term. Okay, you have to always assume it from the old owner. Sir, fair enough. So it will be long-term capital gain based on period of holding of the old owner. Okay. Now on this, I have to calculate the taxes. How taxes are calculated? Let me tell you. Sir, taxes calculation includes two steps. First of all, 235 lakh into 12.5%. That is first step to be done. This is first step. Okay. 235 lakh into 12.5%, which implies 29 lakh 37,500. This is first step. Second step says capital gain recomputed with indexation into 20%. Now we have to do the recomputation work. Again, the hard work is to be done. Full value of consideration shall be 300 lakh minus cost of acquisition. Just a second, just a second. This is CII index. Help me out with it. Cost of acquisition, as we have rightly discussed, shall be 20 lakh rupees. But for the purpose of tax calculation, we have to index it as well. Cost of acquisition is 20 lakh rupees. We have to index, multiply by 376. My point is, since when we are going to index? Are we going to index from this provision 2012 to this, or are we going to index from original owner to the current owner? Are we going to index from the new owner, or are we going to index from original owner? I mean, what are we going to divide? Which CII we are going to divide? Are we going to divide from old owner or from the current owner? Which owner we are going to take? Sir, in this case, we should be taking old one because cost of acquisition is taken from old owner, improvement is taken from old owner, period of holding is taken from old owner. So indexation should also be done from the old owner. But issue is, if you read the Bear Act, indexation is done from normally from the current owner. But we have a case law of Manjula Jesha. It was judgment given by Bombay High Court, which specifically says that indexation can be done from the old owner. So I am disregarding this provision. We shall always consider provision. We shall always consider provision from the old owner only. It is possible that sometimes answer might give you, examiner might give you indexation from the current owner. You have to disregard that. Why you are going to disregard? Because you will be given an alternate answer as well, where indexation is done from the old owner. Remember, answer examiner might do indexation from current owner as well, because legally it is to be done from current owner, but because of judgment in case of Manjula Jesha at Bombay High Court, it was said that you can do indexation from old owner. So we use it as an example to solve every question, and examiner also corrects this thing as well. So we shall divide it by 100. 20 divided by 100 into 376, 75.2 lakh. Cost of improvement, wife did cost of improvement 25 lakh, and improvement was done in which year? Sir, improvement was done in 2008. So 8 9 divide, we have to divide 137 into 376. So we'll have 68 lakh 0.61 lakh minus another cost of improvement 20 lakh. This was done in which year? 2018. So 18 we have to take. 2018 also we shall take. Sir, 18 19 CII would be 280 into 376. 20 divided by 280 into 376. This would be 26.857 lakh. Yeah, 86 lakh. Our capital gain would have been, if we would have sold it this way, our capital gain would have been 300 minus 75.2 minus 68.61 minus 26.86. This will be our taxable capital gain 129.33 into 20%. Our capital gain would be 25 lakh 86,600. This would have been our capital gain. 25 points. So this would have been our taxes plus 15% surcharge plus 4% educational cess. This is how our answer would come out. Okay. Let me, can I say indexation shall be done from previous owner only. Did you understand this point or not? Everybody understood this point or not? I want to raise one more level, one more level. If you can help me out with that. If you agree, sir, it's okay, you can raise our level more, then I will raise it. If you deny, sir, nahi, we are okay, we don't want to go much higher, then I will not raise. Whatever you say. Whatever you say. These provisions hold good in all the exempt transfers. Even in case of any asset, if indexation is applicable, wherever indexation is applicable, sir, we shall do it from the previous owner. Okay. All these provisions apply in case of exempt transfer. Understood, sir. Next level. So Krishna says, sir, as general understanding, can a order by court override the provisions of law? Actually, court is the custodian of law. And yes, court can interpret the law. Court cannot override the law, but court can interpret the law, and interpretation can be overriding. For example, court said that this is incorrect, this is statement, this information is incorrect, we don't agree with this statement. So court can override. Courts are actually the custodian of law only. If they interpret in different sense, then in that case provision shall override. Court's judgment can override. Okay? And of course, principle of natural justice always override. If the judgment by the court is within the constitution limit, if it affects your basic rights, then court can override the law as well. For example, tomorrow courts, for example, government of India says that the number of times you breathe, the number of rupees you have to pay taxes. So can this law be passed? So even if it is passed, this is your basic right now. So court can overrule this judgment and change this. This can be challenged. Okay? Now, sir, next level, you can go to next level. My just a single point. It's actually not at next level. Single point. I want to a single point, very logical point. For example, if this person would have done improvement on 1st April 2024 as well. If this SSC, if this Mrs. Gokul would have done improvement as on 1st April 2024 as well, for example, 10 lakh rupees, how our answer would have changed? How our answer would have changed? Let's see. Okay? Let's see. Our cost of improvement would have increased. This would have been 55 lakh, and this would have been 225 lakh. This would have changed. Correct? Correct. This would have been simply changed because cost of improvement will now be increased. My question to all of you is, when we will be indexing this cost of improvement, so 10 lakh rupees, should this be indexed or not? Should this be indexed or not? Improvement has been done. If you carefully see, improvement has been done a year before. Improvement is not even 2 years old. Should this improvement be indexed or not? My question to all of you. If you are calculating taxes, should this improvement be indexed or not? If you are calculating taxes, should this improvement be indexed or not? Let's see. Let's see. I'll wait for your response. I have no hurry. I don't have to go to office. You have to go to office. See, I am not saying cost of improvement to be indexed for computation purpose. I am saying cost of improvement should be indexed for tax calculation purpose. For tax calculation, I am asking Krishna or Kavya or Deepak. I am asking indexation from the point of view of indexation of tax calculation. Tax calculation, I'm asking. Gokul says should be done for ascertaining tax. Right answer is sir. It should be indexed for the purpose of tax calculation. This 10 lakh should also be indexed. We shall divide it by 363, multiplied by 376, and our answer would change accordingly. What I intend to teach this with, my intention to teach with this point was, it is possible that our asset is long term, but improvement is done a year before. Improvement is just done a year before. Improvement is not 2 years old. Improvement is just done last month only, or last year only. In that case, we might have to index that improvement while calculating tax, even though that improvement is lesser than 2 years old. Improvement is not a asset. Remember, asset has to be long term. If asset is long term, then this improvement will be indexed while calculating tax. So for taxation, it will be indexed, even though it is lesser than 2 years old index. Okay, it is lesser than 2 years old improvement. I hope I am able to make things clear for you all. Okay? Anybody having any doubt in this point? Let me see, did I miss out any point or not? Done, sir? Understood, sir? Anybody having any doubt? Just see. I personally have been a student who has been properly, I mean, what do we call it? Shameless? If I had any doubt, I used to ask to my faculties. I used to disturb them a lot. If you have doubt, it is better to clear it now. Okay? The more syllabus would be over, the more piled up your doubts would be, the more you are going to take time while revising. It's okay to ask. Don't feel shy. Okay? Everybody is in the same boat. The knowledge you have is the knowledge that everybody has. Sir, if improvement is done after 23rd July 2024, will it be indexed for tax calculation? See, if capital asset is long-term capital asset and capital asset was acquired before 23rd July, it will be indexed. If capital asset is long-term capital asset and capital asset is acquired before 23rd July, then it will be indexed. Indexation is dependent upon the capital asset. If the capital asset is long-term capital asset, then indexation is to be done for tax calculation. Got it? Understood, sir. Now we are done with another topic, that is exempt transfer. Let's see where do we stand right now. Where do we stand right now? In this entire juncture, we understood the exempt transfer as well. Now we are left with some kullu pullu topics. We are left with some very kullu pullu topics. Let's do them. Let's do these kullu pullu topics. First of all, I want to take an example. Okay, we are done with the chapter. Almost we are done with the chapter. Now I just want to take the smaller topics and end the session. Okay, end the session as an end the chapter. Just so smaller topics are left which are important. These are not time pass. These are important topics. Okay. What are these topics? First of all, understand. There is a person in United States called Joey Tribbiani. Joey Tribbiani. You know, he's a veteran. He's a veteran investor. He finds out opportunities and he invests in undervalued stocks. Very veteran investor. Joseph Francis Tribbiani. Joey Tribbiani, in short. So Joey Tribbiani found Rahul Limited. Oh wow. Found Rahul Limited. Wow. He really enjoyed Rahul Limited. He saw good potential in Rahul Limited. So what he did in 1st April 2016, he sent $10,000. At that point of time, the dollar was 60 rupees. So he sent 6 lakh rupees, and this 6 lakh rupees were invested in Rahul Limited. These 6 lakhs were invested in Rahul Limited. Beautiful, sir. Beautiful. What else we can have? What else we can have? What else benefit we can have? Perfect, sir. Perfect. Rahul Limited worked really hard day in, day out, day in, day out, day in, day out. Every day, I worked really hard to increase the wealth of the Joey Tribbiani. I worked really hard to increase the wealth of Joey Tribbiani, and it was 1st April 2025 when these 6 lakh worth of shares were 10 lakh rupees. Wow. The worth of the 6 lakh shares, I mean, the worth of this 6 lakh worth of equity has now turned 10 lakh rupees. There was a lady smiling in the corner and asking, "De baba, they tax, they tax, they tax, they tax, they tax." ऐसा करके there was a lady who was crying. Who might be that lady? Our Nimotai. She was saying, "Arey baba, tax, they tax, they tax, they." She was crying in the corner. "Arey baba, tax, they tax, they tax, they." She was crying. She was crying in the corner. Joey Tribbiani calculated capital gain. Full value of consideration was 10 lakh rupees. Cost of acquisition was 6 lakh rupees. Capital gain amounted to rupees 4 lakh, and Nimotai asked to pay 12.5% taxes. Fair enough. This seems logical. Sir, seems logical. But let's just understand the scam behind this. 10 lakh rupees was the value of shares held by Joey. When he sold 10 lakh rupees and bought dollar, exchange rate was 100. $1 is now 100. All thanks to somebody, $1 is equal to rupees 100. That means, can I simply say that now he took $10,000 only? Oh my God. GAWWWD God. What is this happening? Joey came up with $10,000 and took away $10,000, but somehow government managed to bring his capital gain out and tax as well. What is this happening? What is this happening? What is this happening, Baba? What is this happening? Ari, what is this happening, Baba? Just see, just see. Profit of 4 lakh rupees as per Indian laws. As per India, 4 lakh of profit. So government is charging taxes, but in fact, he came up with 10,000 and he is going with 10,000 only. In fact, no real profit. In fact, no real profit. Isn't there some issue in this transaction? Yes, there is an issue. What the issue is, try understanding it. Sir, whatever the increment is in the shares, whatever increment is, the 4 lakh increment, that has been offset by rupee depreciation, or in somebody's language, dollar appreciation, whatever it is. Whatever the gain that have been there on these shares now, that have been offset by rupee depreciation or dollar appreciation, it has been offset. So should Joey Tribbiani be actually taxed in this transaction? Should Joey Tribbiani be actually taxed? Ideally, he should not be taxed because he is having no real profit. No real profit. He should not be taxed. That is why government came up with a proviso. Section 48, Proviso 1. I will come on this proviso again when I will be teaching NR taxation, but right now focus has to be there because this is the area where we'll study the most. Proviso 1, what it says: if a non-resident foreign company invests in unlisted securities, then capital gain shall be computed in foreign currency to remove forex fluctuations. Fluctuations. Okay, this is how capital gain would be computed. To be precise, how capital gain would be calculated, sir? Full value of concession that is there in rupees. This has to be converted to dollar. At what rate? Sir, average rate, that is buying rate plus selling rate divided by 2 on date of transfer. Minus transfer expenses. How the transfer expenses would be converted? Sir, again that would be converted with the same rate. This will be your net consideration. Net consideration would come in rupees as well and dollar as well. Minus cost of acquisition. Sir, cost of acquisition would be given into rupees. That has to be converted with into dollar with average rate buying plus selling divided by 2 on date of acquisition. This will give you capital gain. Capital gain will be rupees as well, and capital gain will be dollar in as well. Now, this dollar capital gain has to be converted into rupees. Sir, how it will be converted? Lawmaker says buying rate on date of transfer. Buying rate on date of transfer. This is how you are going to solve. Let me take an example to illustrate. I'll give you a question. You have to answer. I'll take an example and you have to answer. Okay. There is a person called Joey Tribbiani who sent India $10,000 to buy. Buying 6 lakh rupees of shares. Sorry, buying rate is 61 rupees and selling rate is 59 rupees. If somebody wants to buy dollar, 61 rupees he has to spend to buy $1. If he wants to sell, then 59 is the selling rate. On 1st April 2015, he sent, and his money was invested on 1st October 2020, 2015. Okay, 5 lakh were invested. 5 lakh out of this $10,000, whatever the value has been converted, out of that 5 lakh have been invested into Indian shares. Buying rate on the date of acquisition of the securities is 64 and selling rate is 60. Sorry, buying rate is 66, selling rate is 64. These securities have been held and these securities have been sold for 12 lakh rupees. Buying rate on the date of transfer is 91 and selling rate is 89. You have to compute capital gain for me. I have given you the formula. I have given you the process. I'll wait for 3 minutes and continue further. It's 9:22. I'll wait for 9:25. It's 9:22. I'll wait for 9. I'll wait till 9:25 and I shall move forward. Gokul gave answer 5,13,332 rupees. Beautiful, Gokul. Very nice. Krishna gave the same answer. Very nice. Very nice. Answers are matching. That means somewhere or the other answer would be correct as well. Very nice. Done, sir. We are done with time. If you even if you are solving, you shall continue solving that. Let's try to do. As we have already understood, capital gain, the king is format. Capital gain, entire capital gain can be only solved with the format. If you are comfortable with format, then you will be able to solve every question. So full value of consideration. Do we have transfer expenses? I personally think there are no transfer expenses, so I'm directly writing cost of acquisition, and this will give the capital gain. In rupees terms, 12 lakh is the sales amount. 5 lakh is the cost amount. Capital gain should be 7 lakh. In rupees term, this should be. But since he is a non-resident, Joey, who invest into unlisted securities, so there should be some capital gain. The capital gain should be calculated in foreign currency. Sir, how this should be calculated? We have already discussed the full value of consideration shall be converted with the average rate on date of sale. Average rate on date of sale. So date of sale is this. Average rate is 90. So this should be converted by 90. Can I say $13,333.33? This is the amount of foreign currency that Mr. Joey got. Cost of acquisition shall be converted with the average rate on the date of buying. Shares are bought on 1st October, not on 1st April. 1st October is the date. So on 1st October, shares have been bought, and on that day, average rate is 65. 65 is the rate with which we shall divide. So 5 lakh divided by 65. So our average turns out to be $7692.31. This is the amount at which we have bought. So overall profit to Joey Tribbiani is 1333.333333. Our overall profit is 5641.02. This is dollar. Profit is in dollar. So dollar's profit is of no worth. So this has to be converted back to rupees. Conversion will take place with the buying rate on the date of sale. Buying rate on the date of sale. Sir, we shall multiply it with buying rate. 51333.33. This is the capital gain. Actually, government asks capital gain this much, but we are only taxed this much amount. Okay. Why, sir? Because the balance profit is lost because of rupee depreciation. Balance profit has been lost because of rupee depreciation. Our actual profit is this only. Actual profit is this only. I hope you are able to understand how do we calculate in case of non-resident transacting in India. If non-resident is transacting in India, how transaction take place? This will only hold good in case of unlisted securities. Remember, unlisted securities. In case of listed securities, this is never going to work. We don't have to do this thing in listed securities. This is only good for unlisted securities. Remember, okay? Sir, we got this. Absolutely correct. Sir, we got na minor differences na because of fraction. Will that work? Absolutely, it will work. Like somebody gave the answer 302. That's okay. Minor calculation work, that is absolutely okay. Examiner does give marks for this as well. Coming on to next small topic. 1 or 2 small topics are left and we will be done with the chapter. 1 or 2 small topics are left. Okay. Benefit of basic exemption limit. Another important topic worth your attention. Really worth your attention. Sir, benefit of basic exemption limit. Sir, for example, you are an individual. If you are an individual, your basic exemption limit as per old regime is nothing but a 2.5 lakh, and as per 115 BAC, it is 4 lakh. That means basically up to 2.5 lakh, no taxes are going to be charged. Up to 4 lakh, no taxes are going to be charged. Okay, this is about general income. Whatever general income you have, on this, up to 2.5 lakh, no taxes are to be charged. Up to 4 lakh, no taxes are going to be charged. This is the interpretation of this basic exemption limit. So this is the correct interpretation. Fair enough. For example, we have with us Kavya. Kavya has business income of 1 lakh rupees and she has lottery income of 50,000 rupees. She has capital gain income of 40,000 rupees. Capital gain, which one? Long-term capital gain under 112. Her total income is 1.9 lakh rupees. My point is, sir, basic business income is just 1 lakh rupees. Her basic exemption limit is 2.5 lakh. So she has 1.5 lakh of unused basic exemption limit. Unused basic exemption limit. Can I use this unused basic exemption limit against lottery income and capital gain income? Can I use it? Can I use this unused basic exemption limit against lottery income or capital gain income? Can I use it? Question to all of you is, can I use this unused basic exemption limit against our lottery income or capital gain income? That is a fair question. That is a fair question. That is not a simple answer, to be honest. Set of unexhausted. 112A can be used. That's not fair. That's not correct, actually. Set off of unexhausted basic exemption limit. Sir, first of all, we need to understand, is Kavya a non-resident? Is Kavya a non-resident? If she is a non-resident, no set off allowed. No set off allowed. Every income which is taxed at special rate will be taxed at special rate. Not even a rupee of tax special tax rate will be set off against basic exemption limit if she's a non-resident. So if she's a non-resident, no set off is allowed. Literally no set off is allowed. But sir, if she is resident, then what? Then as a resident, now how things will go? Sir, if she is a resident, you have to see whether she is AOP, BOI, or artificial juridical person. In this case, no set off is allowed. No set off is allowed. But sir, if she is resident plus individual HUF, then in that case, set off is allowed. And which set off is allowed? Lawmaker says 112A can be set off, 112 can be set off, 111A can be set off. But sir, any other income like lottery, online gaming, virtual digital asset, royalty, unexplained income, this cannot be set off against basic exemption limit, not allowed to be set off. This chart is really important. Okay? This seems simple, but this can bring many doubts to you. This can bring many doubts to you during your entire journey. Basic exemption limit can be only set off by resident, individual HUF, and only capital gain income can be set off against basic exemption limit. And it is logical. Why, sir, government allows these things? Because see, just imagine now you are a student, you don't have anything to do, you don't have any other income, but you traded in stock market. You earn 10,000 rupees. During the entire year, you don't have any income. You just have 10,000 rupees of short-term capital gain. Should government tax it? Government says it should not be taxed because see, we want to give benefit now. Indians are already poor. If they are finding small ways of earning things, so government don't want to tax it up to 2.5 lakh. So they have allowed capital gain adjustment against this basic exemption limit. But lottery government doesn't want to let go. Lottery doesn't want to. Government doesn't want to let go. Online gaming government doesn't want to let go. Therefore, they have allowed against these three income, against every other income, basic exemption limit cannot be set off. Done, sir. Shall I take one example to? Shall I take one example? We have with us Mr. Sorry, we have with us Mr. Who do we have? Say Niharika. Miss Niharika. Niharika. Age 21. Old tax regime. Her business income is 1 lakh rupees. Her long-term capital gain of 90,000 rupees. Her long-term capital gain under 111A is 90,000 rupees. Long-term capital gain under 111A, we have short-term capital gain. Long-term capital gain under 112 is 50,000, 1,50,000 and lottery is 30,000. Her total income is 4,60,000 rupees. She is paying tax under old tax regime. My question to all of you is compute her tax liability. I'll give you 4 minutes to solve. It is 9:35. I'm giving you until 9:39. You have to solve this. Compute tax liability. Let's see how many of you are able to think. See, understand, there can be an angle of rebate under Section 87A as well. You are opting under old tax regime, there can be an angle of rebate under Section 87A. Make sure you do not miss that out. Okay? If it is old regime, question might ask you for rebate as well. Let's see. Deepak gave answer 3250. Okay, seems fair. See, answer is not relevant to be honest, Pata. What relevant is how to think. How to think, because this is something that can be asked in MCQs, not beyond that. Not beyond MCQs. This cannot be asked anywhere else except MCQs. Gurnoor Singh Monga. Hello, sir. Hello, Gurnoor. How are you? Acha, Gurnoor is from from our Hindi power batch. So, Gurnoor, I would be pleased if you share your experience from power batch as well. So, student, somebody who is listening for the first time, can even draw from your experience. Okay. How are you? First thing, tell that, and second thing, how is your experience has been? How your experience has been in Hindi power batch? अच्छा in Hindi power batch is already undergoing. ठीक है? It will be over in 3 days. So he still has sufficient experience of how we proceed. I'm good, sir. आप बताओ. Absolutely fine. Absolutely good. As always, smiling, or as always, I am. Last 1 minute, you have to solve this question. Lavanya oblique Krishna says 1170. Gurnu says, just believe in sir, excellent. जितना करवा रहे हैं उतना कर लो, exemption पक्की है. See, Gurnu says that just believe in me. ठीक है? Whatever I ask you to do now, just do that and you'll for sure score exemption. ठीक है? See, people from South India doesn't understand this Hindi, ठीक है? And your language is not even translated. So what Gurnu says, you just have to trust me. That's the only thing that you have to do in the process. Whatever I ask you to do now, you have to follow that, and for sure you will score exemption. ठीक है? चलो, time's up. How to think? How to think in these type of questions? First of all, ji, we have to identify lottery income will always be taxed as it is. There is no option left. Lottery has to be taxed as it is. We will tax this lottery income as 9,000 as it is. We don't have any other option. Lottery income will be taxed. Now comes business income. As a individual under old tax regime, you have basic exemption limit up to 2.5 lakh. Up to 2.5 lakh, you have basic exemption limit. Fine, sir, fine enough. Fine enough. Under old tax regime, 1 lakh will be used against business income. So this 1 lakh of business income is not taxable now. Now you have 1.5 lakh of basic exemption limit left. You have three options. One option is either 112, one option is 111A, and one option is long-term capital gain under 112A. Whatever it is, three options we have. The best option is to save from higher tax rates. The best option to be used is to save you from higher taxes, because this short-term capital gain is going to be taxed at 20% now. This is going to be taxed as per 20%. So it is beneficial to use your basic exemption limit against this. So our 90,000 is also used. Now we are left with 60,000. Now we are left with 60,000. Now we have two choices left. This 60,000 can be used against 112 as well. This 60,000 can be used against 112A as well. This can be used against both the incomes. This can be used against both the incomes. Issue involved is, sir, we should be indifferent about this. We should be indifferent about this. But now your brain should work about education, about rebate under 87A. Under old regime, rebate under section 87A is not allowed against this income. So at least a 25,000 should be taken off from this, so that this incomes become 1,25,000 and this becomes tax free. So 25,000 is used here. Now we are left with 35,000, and this 35,000 we are using here. This will be 65,000 or 55,000, and this will be charged taxes at 12.5%. This will be 6,875. This will be 9,000. Overall, our taxes would be 15,875. Out of this, sir, we will get rebate under section 87A. Rebate is allowed against every income. Every income which is taxed at special rate, we can get rebate. Only income which is under 112A, we do not get rebate. So here rebate will be 12,500 allowed to us, minus 12,500. So 3,375 will be our final tax liability, and plus 4% education cess. Of course, we have to add. So it will be 3,510 rupees. This will be our final tax liability. This will be our final tax liability as per entire provisions. Old regime. Now, given the same case, what if Niharika opted for new tax regime? What would be her calculation? If Niharika opted for new tax regime, her basic exemption limit would be 4 lakh. How her tax liability would change in the given case? How her tax liability would change in the given case? You just have to answer that thing. How her tax liability would change? Try answering this thing. Achha, one reference. Under new tax regime, now whenever you get 87A rebate, rebate 87 is not allowed against any income which is taxed at special rate. Under old regime, you get rebate on all the incomes except for 112A. But under new regime, now you don't get rebate on any income which is taxed at special rate. This is a special thing about rebate under section 87A when you opt for 115 BAC. Try doing it. Try doing it. Let's see. Let's see. See, if you are trying and not able to get answer, you are a hero, to be honest. Because if you are not able to get answer, you can take inference from my answer and understand what went wrong. But if you are the one not even trying, just skipping the video so that you are able to complete the classes faster, then this batch is not meant for you. Honestly, this is not meant for you. If you are not even trying now, please do not enroll for this batch. Entire PGBP would go this way. Entire assessment of various entities would go this way. Entire TDS, trust and taxation, every chapter that I solve, I always give time to you to solve. If you don't want to do that, don't enroll. If you don't want to try, you have to leave early for the office. You have to skip. You have to watch classes in a faster format. There is no need of watching this. No need of watching this if you're not even trying. Somebody who's trying can ignore my words, but if somebody who is not even trying, humble request to you, you will not get this opportunity again. Sir, how answer would change in case of 115 BAC? If you are opting for 115 BAC, your tax on this income shall remain same because lottery is already taxed at 30% irrespective of regime. You have basic exemption limit of 4 lakh rupees. Out of this, 1 lakh would go to business income only. Now you have 3 lakh worth of basic exemption limit. This 3 lakh can be used against multiple other incomes. For example, first of all, you would use against this 112A, sorry, 111A. You would use this basic exemption limit against this 111A. So minus 90,000. You will be left with 2.1 lakh. Now this 2.1 lakh can be set off against both the incomes. I simply want to set off against this 112. I simply want to set off against this. Sorry. My long-term capital gain would become 0. My basic exemption limit is now left with 1.3 lakh. This 1.3 lakh I can now set off against this income. I'll be only left with 112 of 20,000, which would ultimately not be taxed. So my final answer would be just 9,000 rupees worth of tax plus 4% of education cess. My answer would be 9,000 plus 4%. That means 9630. Under new tax regime, answer would be 9630. If you want me to write it specifically, write in a better sense, I'll write it. Just give me a second. If you want this to be solved in new tax regime, I'm just solving. Niharika, age 21, opting new tax regime. How things would go? We have basic exemption limit of 4 lakh. First of all, this lottery would be taxed as it is. 9,000 would be taxed. 1 lakh we can set off here. 90,000 we can set off here. So 1 lakh 90,000 used, 2.1 lakh left. See there, we can reduce this 90,000 and remaining 130 we can use here. So our final income would be 20,000 worth of long-term capital gain under 112A. Simply this would not be taxed because up to 1.5 lakh it is never ever taxed. So our final tax liability would be 9,000 into 1.04, which turns out to be 9360, and this is how your final answer would look like. Okay? In this case, if you see that old regime is beneficial to you, somebody might opt for old regime as well. Somebody wants to go for new, he can go for new as well. Okay? That talks about your basic exemption limit. First proviso, basic exemption limit. What is left in the syllabus now? What is left in the chapter? Liquidation is yet to be done, but liquidation will be only done once we are done with IFOS. Stock in trade or capital asset. If you have securities or if you have shares, when such assets shall be considered as stock in trade and when such assets shall be considered as capital asset, when these are considered as stock in trade. See, it is important for us to understand when these are capital asset, when these are stock in trade. Why? Because if these are capital assets, you will have capital gain. If these are stock in trade, you will have PGBP, that means slab rate, might be 30%, might be 35%, might be 20 or 25%. It can be anything. But if these are capital asset, then reduce tax rates. So you need to have classification. CBDT has prescribed four rules. Understand, huh? First of all, treatment in your books of accounts. If you treat them as capital asset, government will first of all assume it as capital asset. If you treat them as stock in trade, government will assume it as stock in trade. First, as a first basis of determining is your treatment, whatever you treat. Holding period. If you hold them for very long period, more than 2 years, more than 3 years, government might reasonably assume that these are capital assets. But if you hold them for a lesser period, like 1 day, 2 day, 5 months, then in that case, the government might treat it as stock in trade. Quantum of purchase sale. See, if purchase sale is very less, then you might hold them as capital asset. But quantum of purchase sale is very high, very high. Really, you are buying, selling, really you are buying, selling, then government might treat them as capital assets. Sorry, stock in trade. Objective of holding them. For example, you are holding them to earn dividend. So dividend is only earned in case of capital assets. But if your objective is to earn from price fluctuations, then it is stock in trade. What AO shall consider? First of all, AO shall consider the above points. Above point AO shall consider. Remember, if assessee himself treats the assets as a stock in trade, if assessee himself treats securities as stock in trade, AO is not going to argue. If assessee himself says, I want to pay taxes as per slab, AO is not going to argue. Remember, AO is not going to argue. It's obvious now. Assessee himself is paying slab rate tax, so why AO will argue? Sir, if assessee holds listed shares for more than 12 months and assessee offers income under capital gain, then AO shall not question unless this stance has been changed. Understand? If I have shares of Reliance, I show them as capital assets, I hold them for more than 1 year, and I offer under capital gain only. Unless I change my stance, assessee AO is not going to question because I am holding them for more than 1 year now. So AO is not going to question this thing. But if I change my stance, tomorrow I want to tomorrow I want to offer this income under stock in trade, under PGPP, then AO might change its rules. AO might treat it as stock in trade. But basically, if I offer them as long-term capital assets and I hold them for 2 years, then in that case, AO is not going to argue. And of course, listed securities can be sold any point of time, but still I hold for more than 1 year. That means these are capital assets only. One thing, whenever you have unlisted shares, now by default unlisted shares are considered as capital assets only because you cannot buy sell unlisted shares on regular basis. But if you are not genuine about transaction or transaction relates to some fraud or some kind of lifting of corporate wheel, then in that case AO might question your transaction and treat it as stock in trade. This is about capital asset stock in trade. Section 55A, this talks about, for example, FMV. In multiple instances FMV has been asked. If your FMV is as per registered valuer, if FMV has been taken as per registered valuer and AO thinks that FMV is wrong. For example, I have a property and property's FMV has been considered 1 crore and AO thinks no, FMV should be higher. Then he can refer the case to valuation officer. If FMV has not been by a registered valuer and AO thinks that actual value is different by more than 15%, or actual value is different by 25,000, whatever difference it is, whichever is lower, in that case AO might refer the case to valuation officer, or in any another case, in any case where AO thinks that it is necessary to do so, AO might refer the case to valuation officer. So AO might refer the case to valuation officer in case he thinks FMV is not correct. Simple point, for example, if land and building are two capital assets, land is very old but building is just bought, building is constructed last year only. So land or building might be taken as two different assets. Capital gain in case of land will be long term. Capital gain in case of building would be short term. You have to split the fair market. You have to split the full value of consideration based on fair market value. That is how you do it. That is how we complete the entire chapter. Anything missed out? Let me check. This we have done. Indexation we have done. 112A we have done. Exemptions we understood. This exemption done and this also exemption done. CGS I taught you. Cap exemptions I did not miss out any. Advanced money for feature 50 double liquidation is also pending. 45, 4 and 9B we did. Then we did slum sale as well. Then we did ULIP taxation as well. Joint development agreement, compulsory acquisition, conversion, destruction, cost of acquisition in different cases, full value of consideration in different cases, Proviso, first proviso we did, third proviso we did, sixth proviso we did, seventh proviso we did. These provisos have been done. I have not named those proviso, but we have done the concept. Indexation and computation format, I have told you. Exempt transfer and their respective special cases, I told exempt transfer as well. We did that. We understood types of capital assets. We understood transfer. We understood the capital asset as well. We are done with the entire chapter. Come on to question answers. There are 9 questions, out of which 4 we cannot do. Only 3 or 4 questions are there which we can do. Okay? Let's do at least 2 questions today. At least 2. Can we? Or you want to leave for the office? See, I'll just take half an hour to complete the question answers. Half an hour to 45 minutes. 2 questions, or tomorrow we shall do. Tomorrow you have to do whatever you see. Or you want to try question answers of your own today and then we can do it tomorrow. Can you try today? There are 6, 7 questions which you can, out of which few of them you can do. It's okay, sir. We can do it tomorrow. You can do question number 4. I want you should try. Question number 5, I had already given as homework yesterday. You just have to do it. 6, you can solve. 7, I have given as DPQ. 8, we have already done this Mr. Prem question. We have already done under concepts. Robert, we have to hold till NR taxation. Manan, hold till NR taxation. Salsi, already done. Shivansh, hold unless we do a liquidation. So we have only 4 questions in capital gain to be done, because 4 we cannot do, 2 already done out of 10 questions. There are 4 questions to be tried. Question number 13, question number 5, 6, only 4 questions. Okay, you have to try. Can you do it tomorrow? We'll do these questions in 15 to 20 minutes tomorrow, or maximum 30 minutes. Once you will be done with the questions now, it will be easier for me to explain what issues are there in the questions. Okay, try doing these questions tomorrow. We shall complete the question answers. We shall start off with IFOS and we shall complete IFOS tomorrow only. Okay, if you have not enrolled, enroll as soon as possible so that access can be given to you as early. If you have somebody who wants to look for the classes, do share with them because they can enroll as soon as possible. It took us 3 days to complete entire capital gain. Can you believe it? I personally couldn't believe it early, but yes, it is how we have done. I received multiple messages, sir. The explanation that we have done is actually is nice. Students were able to understand everything, and this is how we are going to proceed with the entire batch. What the way we have done right now is the way we will be completing the entire syllabus as well. So you can be rest assured about your syllabus. We did not miss out anything. We did not we did not complicate anything. Rather, we did it in very simplest format, and in 3 days we were able to do the capital gain. One day we'll take IVFOs, 3 to 4 days we'll take PGP, and in that way, in 25, 27 lectures, we should be able to complete the entire syllabus. If you have any doubt, do ask me on regular basis. If you don't have any doubt, then try reading the entire chapter now, because you are done with the chapter. You can solve question answers as well. Take out 2 hours of today. Try solving the concepts, try reading the concepts, try solving the question answers, and close the capital gain for at least the next 2 months. At least for 1 month, close this capital gain. You might not even require to read the chapter again once you read it today. You all have been wonderful students, really wonderful students. I really enjoy. Okay. Did not receive the access for the class yet? Just check out this spam folder. If you did not receive the access, just check out the spam folder. That must be in spam folder. If yet not received, message me out with your order details. I'll share with the team, and then team will get back to you. Okay. If somebody who has enrolled and not received access, just share your order details to me on Telegram. I'll share the details to team, and they'll provide you access. It is possible that order details have been sent to you in spam folder. You can check that as well. Okay. Chalo, have a great day. Enjoy. See you guys tomorrow. Bye bye. Read capital gain, enjoy capital gain, and solve question answers of capital gain. Okay? I am enjoying the batch. I hope you are also enjoying the batch. See you guys tomorrow at the same time.